to restructure debt amid a growing liquidity crisis. We're reporting here at Bloomberg that Zhongji is looking to renew its balance sheet and sell assets in order to repay investors. Meanwhile, rare protests, Lisa, you mentioned this, of about 24 people breaking out in front of the offices of one of the shadow banks as investors worry about missed payments. These are just things coming to the surface again and again over the last few days.
So in one video clip, a woman is seen saying, "Why doesn't the company pay us back?" These are clips that are getting out of the country, which is unusual. This is a country that wants to manage the message, especially at a time of distress. At what point, though, does this highlight the contagion efforts, the contagion risks, I should say, of the housing market, which underpinned a lot of these investments? How far does this go? And at what point does that go more broadly outside of China as well? Again, we don't have a sense of that. And right now, markets in the U.S. are shrugging it off.
Let's finish here on Walmart. Walmart out with earnings in the last hour, raising its annual profit forecast for the second quarter, the second straight quarter, after scoring new sales gains with bargain-hunting U.S. shoppers. This stock is up by 1%. Question I asked last quarter when this happened, and they raised their guidance last time around. If Walmart's raising their guidance, is that a good thing for the U.S. economy? Is that a good sign of what's happening?
It's a great question. I don't know the answer. Why is it that the companies that are doing the best in retail are the ones that sell discount products? Why is it that the bargain hunting types of places are really showing the gains, whereas the mid-tier not so much, luxury only those that really cater to the ultra-wealthy? At a certain point, doesn't this indicate that there is softening, that there is perhaps cash that is going to get run out at some point?
Well, let's hear it from Walmart. Brendan Case here at Bloomberg speaking to the CFO. I'll share a quote of that interview with you all. We're gaining share and our value proposition continues to resonate both for value and convenience. That's the happy talk, the corporate speak. Here's the line of interest. The consumer is still spending, but they're being discerning in their spending. That's kind of where we're at, Lisa. It's not obvious, but there are subtle signs.
And does this really eliminate pricing power? And for who? Does it sort of start to lead to consumer pushback? We're seeing it in certain areas, not in others. I mean, restaurants are packed. Have you seen how much more it costs?
Depends where you go, yeah.
Okay, hold on a second. It depends. It's all more expensive than it was a year ago.
Oh, no,
it's like
absolutely.
Twice as much.
McDonald's is expensive now in Manhattan. Like it's serious money.
Is that where you go?
No. But it is expensive if you wanted to go there.
Okay. You're just channeling TK.
TK frequents McDonald's.
Yes. Oh, yeah, big
That's
time.
his thing. Winnie Caesar joins us now, Global Head of Strategy over at Credit Sites. Winnie, we've talked a lot about fixed income. Yields higher on a 10-year, 30-year. Let's talk about the other side of fixed income, credit. Walk us through why credit spreads are so tight still and near the tights of 2023.
Hey, good morning, Jonathan and Lisa. Thanks for having me. So credit spreads are definitely still at the tight end of the range, which is quite shocking. When you look back at when the 10-year was at 424 last October, investment grade spreads were making their wides for last year around 170 basis points, whereas they're now around 120 basis points. I think there are a few factors. First is the material shift in expectations for fundamentals getting a little bit more positive, seeing the path for a potential soft or no landing is generally a positive thing for credit spreads. I think second, it comes down to positioning for much of the year. At the beginning of the year, people were still pretty bared up on the outlook for the economy. And with that, people were not necessarily putting a lot of cash to work in corporate credit. And it feels like a lot of investors have been chasing the trade as spreads have tightened over the course of the year. And then the last one is just technicals. We have not had enough new issues supply to really put a dent in the demand that there has been for fixed income. When you look at corporate credit relative to equities, it still looks very attractively valued. And so we do think that there is that marginal demand that's going to continue to support credit spreads, although we don't think that we're going to get much tighter from here.
Winnie, John asked me a question earlier this morning. He said, how do we know that rates are restrictive? And I kind of hemmed and hawed and tried to come up with something to say in the moment. It's a great question, though, at a time where risk assets are saying that this economy can look through benchmark borrowing costs of 4.3%. At what point do yields rise to a level where it's clear that they will have an impact on the ability for some of these companies to refinance, on some of the economic momentum that everyone keeps relying on?
Yeah, it's an absolutely great question. And I think there's a lot of confusion around restrictive policy and what it really means. When we look across the broad spectrum of corporate credit, we are seeing that rates are restrictive, or policy is restrictive for those lower rated, highly leveraged borrowers that don't have sustainable capital structures. Defaults are rising, not at a super rapid clip, but definitely at a pace that indicates that there has been tightening in the economy. We've also seen a shift in terms of how management teams are talking about their balance sheets, a move to a much more prudent and disciplined capital structure endeavor so that we're not seeing a lot of pressure on the rating side of things, trying to avoid a downgrade from investment grade to high yield, trying to maintain ratings and really maintain access to capital through a bunch of different avenues. We're seeing not just management teams issue corporate bonds, but also pursue kind of unique structures through securitizations and other transactions.
What I'm hearing from you is that a lot of corporations have immunized themselves against rates and against rates going higher. We've heard that with the consumer with respect to mortgages that are locked in for 30 years. We hear that with corporations that are readjusting their balance sheets and reducing their need to borrow. We're hearing that from a whole host of places. Is the implication here that right now, longer term rates at 4.3% are not sufficiently restrictive to really materially put a dent in any business model that we can see right now out there?
Well, I think that it is putting a dent in some business models. There are definitely business models, particularly in the leveraged loan space and likely in the private credit space, where they are running into liquidity challenges, where they are running into challenges around capital structure sustainability. It's just not the big kind of U.S. investment grade corporate issuers that are running into trouble at this point. Eventually, higher yields will become an issue, but so long as earnings are kind of good enough for credit and earnings are growing at kind of an inflation adjusted pace, then much of the corporate credit universe should be in fundamentally pretty sound shape. And the Fed's restrictive policy is not necessarily intended to cut off access to the investment grade world. They want to see investment grade companies able to borrow. They still want to see high yield companies able to borrow. They just don't want to see kind of risk taking or highly risky behavior within the corporate credit market.
Winnie, within the loan market that you just mentioned, how pronounced is the default cycle that you're seeing emerge?
So the loan market on a default basis is actually not particularly pronounced. And that has to do with some of the kind of structural considerations in the loan market where you have the ability to amend and pretend. So capital structures can just be amended and kind of push out those maturities. And we don't necessarily have to see a true default event. Now, what we are seeing is on a fundamental side, very low interest coverage ratios, especially for CCC rated loans, which are now a higher percentage of that market. And so while we're not seeing the defaults necessarily pile up, we are seeing a lot of sponsors kick money back into their portfolio companies to make sure that they can make it through this, what is perceived as a relatively short-term spike in borrowing costs, especially for those floating rate aligned capital structures.
I guess they hope it's short-term, Winnie. Wouldn't that be the right way of framing it?
That is very true. They hope it is short-term, and hope has not necessarily been the best strategy.
Winnie Caesar at Credit Sites. Winnie, thank you for that. That is the hope right now. Lisa, we talked about it, the hope that this refinancing issue on the horizon, this so-called maturity wall, particularly in high yield, is something we don't have to worry about because the Fed will be in the business then of reducing interest rates because inflation is coming back down, and we'll be talking about the economy recovering out of a downturn.
What I just heard, though, from Winnie Caesar is that a lot of companies, and I would add consumers, that's my words, are able to handle higher rates because of how they've handled their balance sheets, which raises the perspective that we could see rates higher for longer. And that's what people are trying to game out. So at a certain point, that wave of refinancing becomes a real issue because it's coming up next year, the year after. And so at a certain point, you start looking at this, you start connecting the dots, and it's not all adding up in the right way.
Nope. If you're just tuning in, welcome to the program. On the equity market, we're positive here by 0.2%. Joining us shortly, Matt Lazzetti of Deutsche Bank. He's upgraded his view for third quarter GDP. He's going to join us in about 48 minutes' time. Lisa, just to build on what you were talking about, it's intriguing what's happening in fixed income right now. The comfort people have about this maturity wall is just a problem we don't have to deal with. It's out there, and we don't have to deal with it because rates are becoming lower in the future. But right now, that's not the story. That's not the story at all.
In order for rates to go lower, there has to be some reason for the Federal Reserve to cut rates and for people to game out slower growth. There has to be some pain, to use Jay Powell's word from last year. Where is the pain going to come from if these companies see a better economic opportunity, their business models are stronger, we see stocks rallying, something's not adding up because there's not a reason for the Fed to cut rates, which is the reason why in Jackson Hole I want to understand, what is that threshold?
You know who might want a rate cut? Treasury. These consumer balance sheets are so strong because we had a massive transfer from the sovereign to the consumer throughout the pandemic. That's why they're so strong. Rates were so low, which allowed corporates to lock in low borrowing costs and extend these maturity walls. That happened with credit. That didn't happen with the Treasury. The Treasury did not do that in a pronounced or material way, in any way, shape or form. So here we are. I mentioned this yesterday. If you really think it through, the sovereign balance sheet got weaker to enable the consumer balance sheet, the residential balance sheet, to get stronger. And here we are looking at a Treasury market selling off and credit spreads are still what? Tight, and the consumer still doing okay?
So when does that break? When do the sovereign yields matter more than the strength that you see elsewhere?
From New York City this morning, this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside.
You grew up with your mother and your father, and you guys didn't have much money back then?
They really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we presented with the plan.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
It's the consumers at the lower end of the spectrum that I think are being a bit more cautious. And so when you look at our China business and the growth we're talking about, the margin profile is dramatically improved as well, because actually the consumers that are a little further up on the chain are actually performing a bit better than consumers at the entry level. I'd argue that U.S. has been feeling pressure on the consumer side, but the travel demand is tremendous.
Absolutely tremendous. That was from the Samsonite CEO, who knows something about travel demand. Intriguing to get the corporate view on what's happening in the economy, particularly in China. If you don't trust the economic data, you're worried about transparency, it's good to get a look through a company and to their lens through China.
And what we've seen, price cuts, we've seen downgrades, we've seen concerns, possibly retracement and pulling out. That's the reason why you see this this negative feeling right now around the world's largest, second largest economy.
Let's turn to equities. S&P 500 futures elevated, still doing okay, positive this Thursday morning. Treasuries, not so much. Down hard over the last month or so. It's 6 consecutive sessions of yields higher, this time by 4 basis points, just short of 430 after breaching that level earlier this morning. 429.19, Lisa, on a 10-year.
This isn't adding up to me. I'm not understanding whether there is a level on treasuries that's established as being sustainable in the U.S. economy for risk assets to keep doing well. This is a connection that has not been established, and it flies against what everybody was saying 6 months ago. The rates at this level on the long end should disrupt risk assets, should disrupt risk-taking abilities.
Not happening this morning.
Not happening in any way.
Not happening this morning. One company that's doing well, Walmart, once again raising its annual profit forecast. This for the second straight quarter. The stock is higher here by about 1.1%. Better numbers, a beat on a top and bottom line, and a raise to the outlook as well. Joe Fowden joins us now, the Senior Research Analyst and Assistant Director of Research at Telsey Advisory Group. Joe, great to catch up with you, sir, and good to continue this conversation on US retail. We asked the question, I know you've got the answers. If Walmart is doing well, what about everybody else?
Yeah, you know, it really does reflect that there could be some concern for other parts of the economy. You know, we continue to see the high end doing well. The low end is seeking value. The middle income consumer has been trading down and seeking value. And now we've seen that with Walmart. You know, Amazon recently had very good results. And even Target yesterday, you know, their food and consumable side of the business was pretty healthy, and people were trading down theirs to in that area. So, you know, we're seeing increased traffic at Walmart. You're seeing higher sales of groceries and basic items and consumables. So, you know, the consumer's still putting food on the table, and that's an area of focus, but discretionary has been soft, that's for sure.
Joe, how much clarity have you got on where margins are going to be over the next couple of quarters?
Yeah, you know, I'll tell you, Walmart keeps putting up better margins than expected. You know, I think the lower freight costs are helping. And that's helping all of retail. Remember, a year ago, 2 years ago, freight costs were through the roof, especially ocean freight, and that's come down quite a bit. So that's actually helping to provide a little bit of a tailwind and give some confidence, I think, for Walmart and others to raise numbers for the back half. I mean, others are not doing that, but Walmart, for sure, you know, their raise that they gave is just really that confident in the fact that they're getting the traffic, they're getting the sales on the top line, and, you know, they really are getting the profitability they need to drop to the bottom line.
Joe, when you look beyond Walmart, when you look beyond Target, when you take a look at other retailers, do you have a sense of discretionary spending money that people have parked in the bank? Do you have a sense of whether consumers are running out or whether they're doing just fine?
Our view is that the consumer is under some pressure, and they have some money to spend, but it's only in pockets. So if you've planned a trip and you're going to Europe, or you're going to other parts of the U.S., or if you've planned a big event, you know, you're going to Taylor Swift concert, you know, that might take up a good chunk of your discretionary dollars that you would otherwise have spent on some goods. And I think during the pandemic, when we saw people spending a lot on goods, especially home, and coming out of it, you saw a lot of spend on apparel last year, those dollars have kind of shifted elsewhere. So, you know, we've looked at credit. I know consumer credit's been rising, but not to alarming levels as of yet. And so the consumer is out there and able to spend it at the moment. You know, wage growth is still pretty solid. Employment levels are good, but they're not spending broadly. They're just spending within different silos. Obviously, food is one of them. But right now, services, going out to eat, while that is starting to moderate, you know, they have been spending there versus goods.
This sounds prudent. This sounds like good balance sheet management. This sounds like actually responsible consumer spending habits. Doesn't it seem sustainable, and doesn't really speak to some sort of broad slowdown in retailing that a lot of people say has to happen, or consumer spending that has to happen for the U.S. economy to soften?
Yeah, I think that's a fair statement. You know, I think that, you know, when you look at retail broadly, you know, again, anybody offering value, those catering to essential goods are doing well. You know, where was a lot of pull forward of demand during the pandemic, we're still in a normalization phase coming off of that. And I think the consumer has been very prudent with how they've been spending. And, you know, we're hopeful that we're going to have a solid back half and a decent holiday season. You know, we'll hear more from Walmart when they speak in a few minutes. But, you know, it just seems that the consumer has been more resilient than I think a lot of us have given credit at this point in the year.
Before you run off for that call, and I know you've got to listen to that, Target yesterday said this, Joe, that the resumption of student loan repayments would cause additional pressure on strained consumer budgets. Lisa's been saying this all week. The White House instituted a 12-month on-ramp Are they just setting up a decent thing to blame later on this year? Joe, what's your read on that?
Yeah, well, so we did a deep dive report on this and an analysis of student loan debt. And, there's 17% of the U.S. adult population has student loans, federal student loans, that are going to have to start being paid back. Now, they won't be penalized perhaps for a year, so there's a little bit of a grace period. But, our thought process on this was that middle income, middle to upper is where you start to see more of that pressure. Those are the people that do have the student loans. Target's customer is really that customer. And so we called out in our report that we thought Target was among those that might see a little more of an impact from student loans. Maybe less so at a place like Walmart, which sells so much grocery and people have been trading down and seeking value. You don't quite have that at a Target. So I think there is some reality there. I don't think the student loan thing will be broad-based for everybody. Again, the very high end won't be an issue. And then the low end it may not be as much of an issue either. It's really the middle that, once again, is going to get squeezed on this.
Joe, I'm just curious where we are in some of the durable goods sectors, which a lot of people are wondering how long can keep contracting. Are we at a point, an inflection point to the other direction, where suddenly people are starting to go back to things that they shunned after the mass binge buying during the pandemic?
We started to see through the summer some early signs that you might be seeing a little bit of a shift from the services back towards goods. And we're hopeful that will continue into the fall, and, holiday will come, Christmas will come, kids will get gifts, so that spending will happen. We're hoping that shift is a little bit more aggressive back towards the goods on the retail side of the sector. But it seems, again, that there are some initial green shoots there that the good spending might start to come back.
I thought you were going to break out into a Christmas song then, Joe. I hope the kids get gifts.
Kids will get gifts.
I hope they get gifts.
Well, maybe. They'll get something under the tree.
Joe, thank you. Joe Feldman at Telsey Advisory Group. I hope they get gifts. That sounded sad, didn't it?
It's like this complete monotone. Kids will get gifts, and it's, typical.
So you got back to school.
Yeah.
Holiday season coming up. And it is coming up. I know it's deep into August, but
it's so not coming up.
Well, for them it is. You're going to walk into the store in 2 months' time.
It bothers me.
In fact, in a month's time, you're going to see the Christmas trees.
This absolutely bothers me.
You're
I
not
already
alone.
am starting to see Halloween candy in the stores.
Obviously,
Are you joking me? And as soon as Halloween's over, you see Easter bunnies. And I mean, it's like, come on, that's, how many months away? 5?
Easter bunnies come in about January, yeah.
It's ridiculous.
No, I know it's ridiculous.
I mean, and it's the second that Thanksgiving is over, Christmas carols everywhere.
I like Christmas carols before Thanksgiving.
But constant? And then all of the Christmas...
I love a Christmas song.
Okay, all right.
I love a Christmas song.
Are you going to sing for us?
No, I'm not. TK would, but Tom's not here. I miss him.
Yeah, we all do.
We'd like a song going out to break. Scott Cronut of Citi on equities coming up very shortly. That conversation just around the corner. Equities right now doing okay in the face of a bond market that keeps selling off. Treasury yields higher here by 4 basis points on a 10-year, 429.19, and the highest yield we've seen on a 30-year going back to 2011. From New York, this is Bloomberg.
Welcome back to another special Western and Southern Open update for Bloomberg TV and radio from Tennis Channel. I'm Erin Coscarelli. Team phenom Coco Gauff moved into the 3rd round in Cincinnati with a victory over Mayar Sharif under the lights Wednesday night. The victory was the American's 7th win in 8 matches after she recently took her 2nd title of the season in Washington, D.C. And don't forget, you can watch all the action live 11 a.m. Eastern on Tennis Channel. I'm Erin Coscarelli.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
There's a lot of good news out there, but the market, I think, has become a little callous to it.
What is clear is that there is more pain to come, even if rates are already at a peak.
We think inflation will be back to target by the end of next year.
The good news is we're near the end of the Fed tightening cycle.
Are they done? I don't know. There's probably some more room left to move higher.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Decade highs on a 30-year yield. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Farrow. Your equity market, in the face of that, doing okay. 2-day losing streak and snapping back, bouncing back by a mere 0.25% on the S&P. But these moves in this bond market, Lisa, they continue.
To me, this is the key question, the connection between bonds and risk assets at a time where people were thinking about bad news is good news and good news is bad news. Good news is still not terrible news, even though for the bond market it is. And at what point does that shift as people say that yields are too high to sustain the growth that we've seen?
A week away from Jackson Hole and Chairman Powell potentially speaking. What do you reckon he's going to have to say about this?
Does he lean into the market moves? Does he say the market is waking up to what we've been saying for a long time, which is that we're not going to cut rates anytime soon and that we're going to hold rates in a restrictive posture for a prolonged period of time? If he doubles down on that, does that create a more sustainable feel in the market that we currently have and potentially a more significant response in risk assets?
I'm thinking of one policymaker in particular, Neil Kashkari of the Minneapolis Fed, who's taken a lot of stick over the last few years, and I understand why. But his view at the start of the year has stood the test of time over the last 8 months or so. He said, phase one, let's get yields up quickly. He thinks maybe 5.5%. Once you're there, phase two, hold. Push back against that. 8 months ago when people were talking about, can't go too far, and ultimately when they do get there, they're going to have to cut quickly. His view has stood the test of time pretty well so far this year.
This market has been wrong, consistently wrong about how high yields could go and how strong growth could persist, how much consumers could keep spending, how much companies could adapt and adjust. I feel like I'm terrible saying this. However,
you're in the seat.
I'm in the seat, so I have to say it. But that is what has transpired. And at a certain point, then you have to wonder, how does this shift the entire investment regime if rates stay above 4% for the next decade or for the next 3 decades?
Consumer resilience, the story of the year so far. Upside surprises in the US economy. Numbers from Walmart in the last hour or so. Walmart's doing well. Raised their guidance for a second consecutive quarter. You and I have just had the conversation with Telsey Advisory, and basically they're saying, okay, Walmart's doing well. What does that mean for everybody else?
And what Joe Feldman seemed to be saying was, well, if you look at consumer balance sheets, they're being prudent. They're actually being responsible. U.S. consumers are doing what people should do, which is balancing their budgets and deciding where to spend. And so they might spend a little bit more on Taylor Swift tickets, but then they'll pull back in terms of what types of luggage to get for their next trip.
Have you seen the price of them? I mean, come on.
But the reviews are really, really positive. That people, when they go, they're very happy. I'm not a Swiftie,
like 10,
but
20,000 US dollars.
Okay, but that's only for certain premium.
I've heard the
seats
cheap
and
guide is that you go abroad to like Argentina for that leg of the tour.
You've got the inside knowledge.
The tickets are cheaper, and then everything else is cheaper with it because the dollar's so strong and all that good stuff.
Yeah, and then you get central bank reports saying that the reason why inflation is so high in our nation is because of Taylor Swift. And so, you know, or the Beyonce, right?
Beyonce
tickets. We saw Sweden, I think.
Sure. These are the problems we got stateside, right? In China right now, they've got real problems. The currency, the focus this morning. There was a story that we put out in the last couple of hours. The Chinese authorities have asked state-owned banks to intervene in the FX market this week. The potential of FX intervention in China, the potential, and I stress potential over in Japan because we've heard little about it, but we went through the levels on dollar yen in the last 24 hours that we breached in the last 12 months, which triggered intervention from the BOJ. So all of this stuff developing in FX too.
You raised a really important point earlier when you said, you know, maybe the U.S. is doing okay, but maybe things are starting not to break, but to really reach a breaking point outside of the U.S. because of the moves that we're seeing in yields, because of some of the moves that we're seeing with even dollar strength. It's a good question to understand the interconnectedness of this. At what point do higher yields in the U.S. break things elsewhere at a time where China is very much in a difficult spot and Japan is going to stick with their yield curve control, maybe, but abandoning it around the edges?
It's really early days, but dollar strength is not the friend of what's happening in China or in Japan more specifically at the moment. Let's turn to the broader price action on the equity market in the S&P 500. It's just okay, no drama right now. We're positive by 0.2%. The drama has been in the bond market, a 10-year yield through 430, 428, 80, potentially a new closing high potentially for the cycle, and a 30-year. We're through the highs of the cycle intraday. You've got to go all the way back to 2011, and we've got a question. How much of a challenge is this bond market posing to equities at the moment? Scott Cronin joins us now, U.S. equity strategist and managing director over at Citi. Scott, great to catch up with you, buddy, and let's get straight into it. How much of a challenge is that bond market to your stock market?
I think it's a big challenge. I think with the perspective here is that the shock effect on rates, in my view, was last year, okay? As we were going from negative real to positive real, and we were getting comfortable with the changing Fed regime, that led to that very massive multiple correction last year that drove the NASDAQ and the broader market lower. This year, we've gotten a little bit more comfortable that a peaking Fed is in sight. And as the markets rally through this year, the market implicitly has gotten comfortable with the 3.5% to 4% 10-year, which is where most of the trading range has been. So as you begin to move higher through the 4.25, and maybe we're looking a little bit higher, you do begin to reintroduce this issue that as you move away from the AI narrative and re-engage in other stories, rates becomes that, and it does become, in our view, a reason for a pullback phase after the run that we've had in the first 7 months of the year.
Okay, maybe this is a stretch, Scott, but next week, NVIDIA reports earnings. NVIDIA, which has been a major contributor not only to the rally with a 200% gain so far this year, but also to this AI narrative. If they disappoint, could this be a catalyst to rethink the interest rate sensitivity of the biggest component of the index, which is tech?
Well, I think that's certainly part of the narrative here, right? I do think that as we look at this AI narrative, and it is important in terms of an incremental growth driver in the next couple of years, I think the market is still giving many of these companies some room, okay? You're announcing initiatives, but the follow-through from a revenue and earnings perspective is still several quarters out. So I do think we need to be cognizant that the market is comfortable with this incremental new growth driver and potential engine for growth as we look in the 24-25 time frame. But I do think we'll continue to get tested in terms of are you continuing to feed that narrative with enough incremental news to keep it moving? Our view is that there will be enough information here, but you do have to be aware of setups. Where we've been focusing on is the implied expectations for many of these companies. And in some cases where implied expectations get way ahead of consensus, there is some risk.
We've been talking all morning about at what point can this equity market, can risk assets in general keep rallying or at least sustain current valuations with rates significantly higher. It seems as though the actual strength in earnings has defied a lot of expectations. The ability to rearrange balance sheets has defied expectations. And in a world where people are not sure of a bond yield, equities have been a haven of sorts. How long can multiples keep expanding, even in the face of higher rates, given this resilience?
Lisa, the highest correlation I can find between equity performance and drivers over long term is with earnings. Okay, 0.95 R squared going back to the early 60s. Earnings tends to lag S&P price action by, let's call it, 9 months. Okay, so essentially what happens here is this move in the market is setting up expectations that you need to see earnings follow through. Now, in our work, we actually do think that we're going to see earnings acceleration next year. We're looking for low teens earnings growth for the S&P 500, and we get there through several metrics. But essentially, that becomes the issue. I think what we've seen this year is a more resilient earnings picture. We've been talking about that for some time. As we look ahead to 2024, you do need to factor in soft landing or not. But the way we think this is setting up is that you're going to see the earnings growth next year to support this, and more importantly, we're starting to look at an inflection in free cash flow. And free cash flow growth is really critical because what it does do, to your point, Lisa, it really opens the door in terms of financial flexibility for how C-suites respond and engage in activities, whether it's repurchase activities, capital spending, or even debt pay down. So the flexibility that comes with improving free cash flow is pretty important, and we have to keep in mind the starting point is that free cash flow levels improved roughly 50% in the 2 years coming out of the COVID recession. So again, we think there's some angles here fundamentally that provide ongoing support for the equity markets.
So at what point do you step in and really start buying significantly some of the areas that are getting beaten up over the past couple of sessions?
You know, what I would say is that my benchmark, and this is pretty subjective, is that you have a run of this magnitude, and you have to presume that somewhere in there you have to get a 5 to 10% pullback. And if the fundamentals are still in place as we think they're going to be, then that's the metric that I'm kind of using. So, you know, your starting point is in that mid 4,500 level.
Scott, I just want to finish on the retailers, if that's okay. We're just hearing from the Walmart CEO, Doug McMillon, and he's saying that the headwind that they see coming is going to come off the back of U.S. student loan repayments. We heard something similar from Target, who said the resumption of those payments will cause additional pressure on already strained consumer budgets. Scott, have you and the team done any work on that, on what effect you think that's going to have on earnings from some of those names?
Yeah, it's something that we've had on our radar for a while. It's very hard to get granular on it and bring it down to company specifics, and can't really do that here. But what I would say on this is that with the retailers, there are a couple of things going on. First, expectations for consumer discretionary came down the hardest last year of any sector, okay? So the setup going into this year is an interesting one where a lot of the negative concern regarding recession risk is priced in. You kick the can on recession and the consumers are natural fallout of that. Yes, we're going to have to contend with higher inflation impacts, higher interest rate impacts, throw in student loan debt issues kind of coming in here. You still have rising wages, and you still have an angle here where there's an offset to student loan payments for a certain consumer cohort. It's what you're now earning on savings. So there are some balances on this. What I really think is important, though, in looking at the retail landscape is the result so far is how these companies are able to manage a fairly mixed setup, right? These companies are, in our view, at the cutting edge of how we think about utilizing technology. to better manage your business. And in so doing, you avert a lot of the traditional business cycle effects. And so this is a theme that we think gets underplayed in the market. And the results so far with the retailers seem to support this notion that they're actually doing a really good job of managing what they can control on this. And that's kind of showing up in terms of earnings and margin profiles.
Interesting. Scott, thank you, sir. Scott Cronin there of Citi. Busy morning for everyone at the moment. Equities right now on the S&P 500, if you're just tuning in, positive here by 0.2%. Coming up on the U.S. consumer, on the U.S. economy, on the U.S. labor market, Matt Lazzetti of Deutsche Bank, who recently upgraded his call on third quarter GDP, reacting to U.S. jobless claims due out in about 15, 16, 17 minutes. Lisa, it's the blame game on Wall Street, and it starts on Main Street pretty early for Target and Walmart ahead of these student loan resumptions.
Yeah, and what we heard from Scott Cronin there is saying, well, they at least have gotten more efficient at cutting costs at the companies to be able to maintain some of these headwinds. Again, we keep talking about how much of a headwind is actually going to be. I mean, if there are people who are already planning not to pay, then you have to wonder whether that's going to limit some of the damage, the bleed through. I mean, eventually they're going to have to pay, presumably.
If there's a 12-month on-ramp, which you mentioned earlier this week, if there is a 12-month on-ramp and you're going into the holiday season, wouldn't you just start paying like in the new year? Isn't that when you'd expect that headwind to hit?
If it was me,
that's what I would do.
This is you do because the kids will get gifts.
There's no punishment whatsoever to wait.
Yeah, exactly.
So why wouldn't I just wait?
Which is what a lot of people are gaming out, which is the reason why it won't be that substantial of a headwind. Some people think, but evidently Walmart and Target do, and it's something to consider.
Just kind of lowering the bar, aren't they, as we get to the back end of the year? Maybe. James Athey of Aberdeen coming up next from New York City. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Next week, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go. What are we going toward?
Coverage starts Wednesday, August 23rd with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
You take 2.5 and for inflation, you take 1.5 and you take 75 basis points, which is lower than history for term premiums, you're looking at 475 on the 10-year, and it obviously could end up being higher than that.
I love Larry. He's obviously fiercely intelligent. Larry Summers there, the former US Treasury Secretary, but that sounded like a chef making a meal.
Well, that's
You
kind of
take
what it
2.5, you throw in 75, you take another 1.5.
It's true.
Bramo, you
Yeah,
get
exactly.
to 475, and that's where the 10 year's going to be.
The way he talks is so it's just
Bang.
obvious. Come on, this is where we're heading
And
right
then he's
now.
going to tell us it was never a forecast. It was just an economic model. It's just a way of thinking about the
was a
Treasury
recipe
market. Yeah.
for a
yeah.
ratatouille of monetary policy.
Give me a break. In the bond market right now, on a 10-year yield, let's call it about 430 on a 10-year. I won't slice and dice that for you. I'll slice and dice the 30-year for you. The 30-year yield at a high we haven't seen since 2011. What, slice and dice?
Yeah, that was good. That was really
nice,
good.
Nice.
That was good.
Let's just get to James Athey over in London,
You're gonna cook up a
investment
recipe
director over at Aberdeen. James, great to catch up with you. It's like the question of the week. What's it all about, James? What's behind this bond market move?
Hey, John. Yeah, I mean, it's a good question. It's been a very strange few trading days. We had stronger US data and the market seemingly couldn't sell off at all. And then we've seemingly got these kind of random sell-offs out of nowhere with not much behind them. I mean, Larry Summers there, I agree with you that it's all a bit spurious, some false accuracy in there, but I think that term premium element is certainly part of it. But if you look at the equity market, 11% earnings growth price for 12 months ahead in the S&P and trading at 20 times roughly, that looks like a pretty nice, if not soft landing, yet you've got this massive inversion in the bond yield curve. One of those is wrong, and it looks like they're kind of converging from both directions, which is probably reasonable given the data we're seeing in the US.
Does it make sense to you, James, that we're seeing risk assets hold in there despite some of the moves that we're seeing in benchmark bond yields?
Is that a loaded question, Lisa, because you and I tend to be the only bears that are speaking publicly?
Carry on.
I found it difficult to explain or justify really that rally in the equity market from a fundamental or from a probability-weighted, risk-adjusted basis. It looked like there was a lot of short covering in that, in spite of the fact that obviously the economic news has been better than expected. So I am generally surprised at how well equities can ignore some of the macro drivers. But it's hard to pick holes in, for example, retail sales data this week. It's hard to try and claim that the consumer is on the precipice when the spending numbers are as strong as that. And so whatever the data's okay, I think equities can hang in there.
What about credit? We were talking about how narrow credit spreads were, and we were talking with Winnie Caesar about how much companies have readjusted to prolong some of their payment structures and increase their cash, shore up their ability to maintain themselves through this period. Are you getting bullish on credit, or do you think that it's over its skis? How do you sort of rationalize?
Well, so I think the spreads are too tight, broadly speaking. I don't think you're really being accurately compensated for the likely default risk. You can see that realised defaults in most countries and regions have been ticking up to a far greater degree than we've been used to. So I don't think the spread component is necessarily attractive. But what the bulls and a lot of credit guys will tell you is that the all-in yield is very attractive, obviously because of the cheapness of underlying government bond yields. And I think that's reasonable. So I think if you're being selective and choosing high-quality corporate credits, you've probably got some nice investment opportunities there. One of the really interesting charts that I've seen recently has been that a lot of companies have actually benefited from higher rates. You know, they engaged in precautionary borrowing sort of for 5 or 7 years when rates were low, and now they get to park that cash at the deposit rate or at cash rates, which are 5.5%. And so in spite of this monetary tightening, it's actually generating positive cash flow for a lot of these cash-rich corporates.
Hey, James, we've talked about this kind of stuff before, but there's often a geographic, regional bias on certain issues. If you ask someone in New York on Wall Street about China, shrug of the shoulders. And the stereotype would be, for the boomers at least, tell me where the Dow is and move on with life. In London, there's a much more nuanced view about macro and China specifically. James, what's the view on China right now in the city?
Yeah, I mean, I think people are nervous/cautious, but to be honest, as is often the case, you know, most folks are biased to believe that we will see what we have seen, and that is when China has a bit of a wobble, we should just expect quote-unquote stimulus, and that'll lead to a positive reaction from markets. So it's not something that people are really kind of looking to play as a macro theme. And the door doesn't swing both ways. When the US sneezes, the world catches a cold. The US is a massive consumer with a huge current account deficit. China really is consuming domestically and exporting a lot, and so it's not the same linkage, but you are seeing, I think, places like Australia and Germany likely to struggle going forward. But most people, I think, want to buy dollar CNH as an expression of China concerns, maybe sell the Aussie dollar, but not much else.
So, James, with that in mind, are we thinking about it the wrong way round? Not how China influences the US, but how the US influences China, given what's happened with real rates and what could happen with the dollar going forward from here?
Yeah, to a very great degree. I mean, you can see the Chinese policymakers, the PBOC, really trying to offset this weakness in the yuan. I guess they're worried about a similar situation to 2015 emerging and capital flight and creating bigger stability problems for themselves. But they are fighting what looks to be a pretty losing battle because the US data is just holding up that much better than everywhere else. And so in spite of the market desperate to trade carry, to trade risk on, the US dollar really is just starting to generate a bit of upward momentum because I think we are in a US exceptionalism world, at least for now. And that does create problems globally. It does create problems for dollar borrowers. We know that.
So what are you doing right now, given the fact that some people are saying we're at an inflection point? Do you believe that? Are you shifting some of your allocations in response?
I mean, I've been saying that we're on the precipice of an inflection for quite some time, and sometimes you look really clever and sometimes you look really stupid. It's been that kind of environment. Bear, bull, flatter, steepener, we've had it all over the last 8 weeks. I do think Europe is starting to show its true colours. They've got structural weakness and cyclical headwinds now because of policy and the pandemic effects subsiding, so increase a bit of duration there. And I think the US yield curve, I think there's a good chance it can steepen both ways. I think it can bear steepen in a soft landing, it can bull steepen if the data disappoints. You know, I love an asymmetric position, so adding to steepening risk and actually been paying US 5-year, because that looks really low, and if we get a bear steepener, that should rocket higher. But beyond that, it's quite difficult. Still trying to cling on to the more medium-term positions, generally being defensive, and hoping that the forward-looking indicators will give us an accurate indication, and that suggests things will get worse from here.
You mentioned a short squeeze. How much have the shorts been squeezed out? How much are people really long this equity market at a time where there are some real questions?
I mean, it's always difficult to say with any degree of accuracy, but if you look at surveys, if you look at sort of FMS, Hartnett's flow show type stuff from BAML, and you look at various other indicators and surveys that we would look at, it does suggest that there has been a shift. Sentiment has shifted away from expecting a recession, actually, to the majority of people not, from people being underweight or short equities in decent size to people being neutral to long. I think from a quantitative perspective, the CTAs, the vol control, the risk parity, these guys have not only been buying on rising prices, but they've been adding gross risk because of falling implied volatility. So I do think we're getting to that stage where most folk are now on the other side of the boat. That suggests it should take less to tip us over.
I love the flow show note. Michael Hartnett.
I do too.
At BFA. It's one of my favourites. Out on Friday. James, thank you. Love the new dress code over at Aberdeen as well. James Athey there of Aberdeen over in London. I couldn't let that go. He looked so sharp today.
Good.
I thought he looked really sharp in the shirt.
Good.
Without a tie
Just
and no jacket.
Be clear that you're not being sarcastic.
I'm
just confirm.
There is most definitely a night out tonight in London for the team at Aberdeen.
You
I'm just going to say,
let him go.
Without a doubt.
You cannot let him go
without
and then spread rumors about,
that is not a rumor. Without a
You're
doubt.
going to say, okay.
There is a Thursday night out in the city because you take off Fridays now,
Right.
right?
That's
You
evidently
work
what
from
happens. Yeah.
home.
Although even Tuesdays now are a
Tuesday.
night out.
Is Tuesday the night out?
Tuesday, Wednesday, Thursday.
Just the whole week.
Yeah. Like,
but don't come in on
businesses
Friday.
are trying to rearrange restaurants.
Right.
Come in Tuesday. It's going to be good.
Tuesday nights are a thing.
Yeah.
You
Tuesday,
making that up?
Wednesday. I'm not making that up. I'll send you
Who's going out
evidence.
Tuesdays? I don't believe you. Jobless claims coming up next.
Go
Matt
on,
Lazzetti of Deutsche Bank. Neither do I,
Let's be
really.
honest.
The only one with a social life is TK. Matt Lazzetti of Deutsche Bank up next from New York. This is Bloomberg.
the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
It was bustling on a recent night at Avra on the 60th Street and Madison Avenue. Tuesday's a new Friday, New York Post.
See, there
Didn't
you go.
know. I was in Avra yesterday.
Yeah.
It was bustling at lunchtime. It
At lunchtime.
always is. Jobless claims, just around the corner, seconds away. Equity futures on the S&P 500, positive here by 0.25% going into that print. Yields are higher by 3 basis points. Your 10-year, 4.28. The jobless claims number looks a little something like this. 240 was the estimate. 248 was the previous number. And I'm waiting for the number to drop across the Bloomberg.
And you're doing
It's
a great
taken
job, by the way.
a little while. I'm just going to tap dance
Yeah,
a little bit
it was
longer,
good. The tap
Brownlow.
dancing
Work
was
with
really
me.
good.
Jobless claims historically are at really, really low levels. Even at 240, it's been phenomenal. And it speaks to the fact that this labour market is still tight, with unemployment at 3.5%. Even as job openings come down, Lisa, we haven't seen the pain in jobless claims.
Some people saying it's labor hoarding. Some people saying it's just supply and demand. We are getting some figures, so if you want to take a look at them, but it looks like we're not necessarily seeing any massive tick up.
239, it's as you were. The estimate, congratulations, Wall Street. 240, the number comes in at 239. The previous number, 248. I'll wait to see if we get a revision. Off the back of that in the equity market, not much price action for you. Still positive by 0.25% on the S&P 500. Yields are higher still on a 10-year by 4 basis points. 4.29 on a 30-year higher by 5 basis points at about 4.40. Coming up on the open in the next hour, Eric Knudsen of Neuberger Berman, Megan Swiber of Bank of America, Anastasia Amoroso of iCapital, and we'll catch up with Mr. Oliver Chen about retail, Lisa. All of that still to come in the next hour on Bloomberg TV.
Ask Oliver what you should wear next time we have a Tuesday night outing for the team. We're going to go out. Tuesday's going to be the new Friday.
He's so much sharper than I am.
And we're going to go out at
I don't think I could wear the
3 p.m.
Oliver Chen look.
Yeah, well, anyway, I'm
dude is sharp.
curious. Well, thank you. And I am curious to see whether Tuesday will continue to be the new Friday when they call everybody back to work, which seems to be something that's happening. We've been asking a lot of questions around how long the retailer can keep going, how long the consumer can keep spending, whether they're running out of cash, whether they're going to be challenged by some of their student loan payments. Matt Lazzetti has been upgrading his expectation for growth in the U.S. He has been spot on, pushing out his recession call. Chief U.S. economist at Deutsche Bank, joining us here in the studio. Matt, just first read on what we've seen in terms of retailers, the strength, the labor market not cracking. Is this an economy that can subsist with rates where they are for a very long time?
Look, I think right now it looks like the answer is yes in the near term. We just upgraded our Q3 growth forecast to above 3%. You know, everybody was anticipating, I think including the Fed, as we saw in the minutes yesterday, that you would see this second half of the year growth slowdown, that you're beginning to see rates bite, that the tightening of financial conditions and bank lending conditions was going to be impacting the economy. What it looks like we've seen with the data so far, now it's only a very little bit of data for Q3, is an acceleration. For the consumer, for industrial production. It goes against certainly what we were anticipating at this point in time and raises really important questions, I think, for the Fed.
One of the questions, and John asked it earlier, are rates restrictive currently? How do we even know if they are restrictive?
Yeah, I think the way that we typically view that is, you know, either through real rates, the Fed leans very heavily on real rates. And there we are seeing very significant increases in that, you know, 10-year real yields at many-year highs. I look at, if you look for your 5-year real OIS, so a measure of what our star type estimates are. All of these things have been rising pretty substantially. But then when you translate it into financial conditions, it's not obvious that things are too tight. Most financial conditions indices are loose, have been loosening. The one area where there is tightness is bank lending conditions, but we haven't seen that impact the economy as of yet.
So just taking a step back for a second before we get into the nitty gritty and I ask you about student loan repayments and all sorts of other issues that are capturing people's attentions. There is a question of whether this is long and variable lags or if this is companies that have pushed out the maturities, consumers that have pushed out their maturities, and a lot of resilience at a time where consumers keep spending. Is this an economy that can keep humming along even if the 10-year rate continues to go up, even if we see 4.3% on a sustainable basis?
Yeah, so our baseline is no. We still have this mild recession in the forecast, that we still think the bank lending condition tightening that we've seen, the real rates that we've seen, some of the headwinds for the consumers that are coming up, the student debt payments, the slowing labor market. You're seeing rising delinquencies within the consumer for both credit cards and autos. And so our baseline is no, that this is an acceleration, but it'll be short term. Eventually, you'll see monetary policy tightening take hold. But on the other side, we're being surprised by the data here. And when you look at the incoming data for the labor market, obviously initial jobless claims not showing any uptick, any softening there. What you're seeing in the retail sales report is broad-based. Consumer confidence is picking up a little bit. So there are some elements there which make you a little bit more cautious or in terms of thinking about that slowdown in the economy.
What do you have to see to change your view?
So I think, to go fully towards a soft landing, and I think we've been noting the prospects have been rising here, you need a few things. I think you actually do need to see the economy slow. And the reason that you need to see the economy slow is because the Fed has been very adamant that if it doesn't, they think that they have more work to do and that they can't have confidence that inflation is going to come down to target. We heard that from Powell at the July FOMC meeting. I thought we heard it, and that was the big takeaway from yesterday, that they need to see a slowing economy in order to get confidence that inflation is coming down. So I think you need that. You need to see wage and price pressures coming off. We're seeing some evidence of that. The last 2 inflation reports from CPI have been very supportive. The PCE report next week will be a little bit less so. But I think that's what you need. We're not getting that evidence on the growth front as of yet. And so I would anticipate from Powell probably next week, Jackson Hole, from the Fed, that they lean into a hawkish bias still. That the September SEP probably still shows some idea of rate hikes in the profile. And then more importantly, that they will probably hold that for even longer than anticipated.
Let's talk about some of the potential drivers for weakness that might take hold next year. It's what everyone's been expecting, and they've been saying this for quite a while. So we'll put that as a caveat. Student loan repayments. This has been a hotly debated topic, with some people coming out and saying, well, if students don't want to pay or former students don't want to pay, they don't have to. They're not going to be penalized for 12 months. And other people saying, well, they're going to try and they're going to have to pay back. Eventually, it will crimp their discretionary spending. Where do you fall on this?
Yeah, so we've thought that it's going to be this meaningful headwind to the consumer. If you look at student debt payments in the daily Treasury account, they're down about $70 billion relative to where we thought they would have been. So that's a meaningful hit to consumer income if it gets paid in full. There's been certainly programs there that are trying to alleviate some of the pressure on consumers in terms of paying that over the next year or so. But we can track it on a daily basis. And if you look at the Treasury daily account, you are seeing a meaningful uptick in payments taking place. So people are paying down their student debt that were not doing so previously. But my guess is that the impact is going to be less than anticipated, or less than it was previously, simply because there are these programs that are trying to take away some of the pain.
We're speaking with Matt Lazzetti, Chief U.S. Economist over at Deutsche Bank, at a time where we're seeing strength pretty much across the board. We got reports out of retailers, including Walmart, Tapestry, Target yesterday, all of them showing strength in the consumer spending. Are you seeing any evidence that people are wholesale pulling back or not able to spend with such profligacy of the recent past?
Yeah, I think some things that you would point to are not primary but kind of secondary. So there's evidence that excess savings have been drawn down. The San Francisco Fed put out a piece just this week saying that it'll be gone in Q3, the current quarter.
We've been talking about this forever, haven't we? We've been saying it's going to run out, and it never does.
So that part, our view was always at the back half of this year, at the end of this year. And so I think that part is coming to fruition. I think you're seeing the evidence of that through, you saw rising credit card borrowing. You're seeing rising delinquencies. Those are now higher for autos and credit cards than they were before the pandemic. And so there are some strains there. Now, obviously, so far, that has not translated into retail sales data. It hasn't translated into the the high-frequency credit card spending data that we've seen. And so far, there's not evidence of that. Obviously, the big question is, can that continue to run even as you have credit card debt picking up, you have delinquencies rising, strains are there, excess savings come down, student debt payments come back. Again, our baseline is that it can run forever and that you'll see a slowdown that takes place, but the data have surprised the upside.
Everything that we're talking about almost presumes American exceptionalism, that the U.S. economy can remain divorced from everything else that's been going on elsewhere. And I think about China, and every morning we come in and we open with China and we discuss everything that's happened and the weakening there. When you look at the connections between the world's two biggest economies, how divorced is the U.S. from catching a cold from what China seems to be experiencing right now?
Yeah, I view it maybe through two channels. I think directly economically, as we look at the U.S. economy today, I think it is primarily domestically driven. It's about the services economy. It's about the U.S. consumer, and whether or not Chinese consumers is strong in that environment is less relevant. So that direct economic impact to the U.S. I think is probably more muted. Where I think it can have important linkages is through financial markets, and I think some of the risk aversion that we're seeing is certainly being driven by what we're hearing in the daily headlines that you get out of China. If it is to impact the U.S. economy more significantly, I think it has to be through financial markets that you get turmoil that takes place there. And I think it's an interesting question. We talk about high real yields, high yields maybe not impacting the U.S. consumer as much, but perhaps where we're seeing it is more on the global sphere, and that's where it's beginning to bite, and maybe there will be spillovers, but through financial markets.
And this is a reason why people are wondering whether things are getting close to a breaking point at a time where the fundamental economy seems to be doing just fine. How closely do you watch that? The financial transmission mechanisms, the surveys that come out, but also just some of the fissures happening on the global market sphere?
Oh, I think you have to, follow financial conditions, however you might define them, very, very closely. I think we always, part of the reason that we anticipate, or people are anticipating we can get the soft landing, is because you're getting the economic data take place. You're getting a Fed that was hawkish and raised rates very substantially, but financial conditions have not fallen apart. I think if you see equities come down, credit spreads widen, the VIX come up, financial conditions tighten in a sharp and aggressive way, that often leads to very quick changes in narratives. And so if you get that taking place for whatever the reason might be, I think you'll see kind of a downgrade of soft landing prospects.
What do you think people are getting most wrong right now?
I think it's a difficult environment. If the economy is actually accelerating, then that is certainly, I think, one that is getting wrong. On our baseline, we still think that you have a recession. That is not the prevailing narrative in the market right now, even if it's the baseline for most economists. So I think if you get that, the correction in markets that we would need to see would be pretty substantial. The extent of Fed rate cuts next year would be far more substantial than what the market is pricing.
Matt Lazzetti, Chief U.S. Economist, joining us here over at Deutsche Bank. There is a question about whether markets can consistently see yields rising to this degree, the highest going back to 2008 for the 10-year yield, the highest going back to 2011 for the 30-year yield, without some sort of ramifications for risk assets. Right now, we're still seeing risk assets hang in there, eking out just a bit of gains after 2 consecutive days of losses. And this is what we're really watching. Can it continue? Well, what we have seen this morning is it has built. We have seen the S&P up 0.3%. And if you are just joining us now, we could see even crude levels coming up, $80.25 gaining despite some of the concerns over in China. S&P futures 44.33. Matt Lazzetti, the real question that I have from your seat over at Deutsche Bank is the work from home thing. I'm sorry, I don't mean to put you on the spot, but we were talking about Tuesday as the new Friday. And I keep hearing more and more offices, the obituary was written prematurely. How much are you hearing everyone coming back and the economies that kind of were around those offices also coming back?
Yeah, I think, for us at Deutsche Bank, we've been back in the office for a while here. As research, we have a little bit more flexibility, which is nice, I think. But we have a nice brand new office on Columbus Circle, so that's been a pull for us.
Deutsche Bank
the Deutsche Bank Center, as we often talk about here.
Do you call it that?
Of course I do.
Really?
Of course.
Yeah, so do you correct your family members when they say the Time Warner Center?
My family members don't talk very much about
They don't talk about it. They try not to bring it up. You know that you have a difficult thing about it.
Exactly. But no, I think, in certain areas, there will be a pullback. pullback to the office that takes place, and I think that there'll be positive benefits to cities as a result of that. There's going to be some elements of it that I think are more structural. So I think once that happens, you'll have companies that are competing for workers in what is still a pretty tight labor market, and one of the benefits that they can provide is going to be that work from home environment.
Are Tuesdays the new Fridays?
I don't know about Tuesdays.
Thursdays?
Maybe Thursdays, although I'm not dressed for
Thursday, for going out.
Exactly.
You're not dressed like how they do in Aberdeen, Mountain City, of course. Thank you so much for being with us.
Thank you.
We really appreciate it. Coming up, we'll dive further into the retail sales, and we'll also dive further into what's going on with China. Coming up, Lupin Raman of PIMCO to talk about what the transmission mechanisms are, perhaps not necessarily even in the U.S., but Southeast Asia, the economies of which had done really well to this point. This is Bloomberg.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
He's
story.
there, the kind of upside.
Heaven forbid we have a replay of 22, and inflation surprises to the upside on an ongoing basis, and central banks turn more hawkish. That would be pretty bad news for our strategy, for positioning in general, markets in general. And unfortunately, we are sort of seeing signs of reviving inflation in commodity markets, labour markets staying strong. Even falling inflation itself can bring about its own demise.
That was Ben Gooderidge, investment director at Invesco Solutions, trying to game out how this is going to work in a time of great confusion, trying to make sense of yields at the highest levels going back decades, or at least more than a decade. You're looking at a dollar that was strengthening, at least until today, at the highest levels since the end of May. If you look at the Bloomberg Dollar Index, you're looking more broadly at this sense that U.S. equities can rally even in the face of weakness in places like China, even Europe feeling more of the Chinese weakness, the U.S. remaining in an exceptional position, at least for now. Crude. If we get that slowdown in China, why is crude continuing to rally north of $80 a barrel? It had softened a little bit, but inventories are clearly tight. You're seeing them drawn down, and that has been affecting the price. China very much in the focus. And John asked a question earlier where he was saying, how much is this a China issue? And how much are some of the questions around the currency and around financial markets really a matter of the U.S. dollar and the U.S. strength and the U.S. rates picture, kind of creating some issues for the developing world and China in particular. Joining us now to parse through some of these concerns, some of these dissonances, Lupin Raman, head of EM, Sovereign Credit and Portfolio Manager at PIMCO. I'd love to start there, Lupin. How concerned are you, as someone who focuses on the developing world, about a stronger dollar?
So the stronger dollar is an effect for emerging markets, which can be quite negative. But I think this time around, there are good reasons to think that, emerging markets are going to be a bit more sheltered than before. One of the key factors is what's driving the dollar strength, and part of that is this soft landing narrative in the U.S. So markets and the real economy that is a lot stronger than people had originally expected. And I think for emerging markets, that is really playing out in terms of where the growth outlook for EM is. It is slightly softer given the drag that we're seeing from China, but the strength from the U.S. is keeping many EMs, particularly in LATAM, buoyed and growing stronger than they had expected.
So we'll get to that in a minute. I do want to touch on China, though, because that's kind of the elephant in the room, particularly for Southeast Asia. And it seems as though whatever message the Chinese Communist Party wants to put out there, the economy is struggling to perform, even with the expectations that have already been brought in. How much does it have a bleed-through effect that was unanticipated to the entire region and the debt and equities therein?
So I think China struggling is a concern, given that we are in a multipolar world right now. What is slightly different about this cycle is that it was expected to be a lot more services driven, so a lot more internally focused than being driven by the manufacturing cycle, which would have the larger impact for the rest of EM and East Asia in particular. I think that what is different now is we're seeing the PPI deflation, and that can have an impact on prices going forward for EM in a positive sense, really continuing some of that disinflationary trend. But I do think that having a China that is weakening more than expected without government authorities really having an all-in type of narrative is quite negative for EM sentiment.
So let's just pick through some of these ideas, because you're saying that disinflation or deflation in China might be positive. It might allow for disinflation or deflation in other nearby regions. Are you saying that on the margins it may be more of a positive than a negative for some of these nations?
I think that on the margin it can be a positive factor in terms of really allowing that disinflation process to ride through for the rest of emerging markets. And essentially EMs are in a kind of Goldilocks type of scenario where growth is still reasonably positive. They're not in deep recessions, but you're still seeing this immaculate disinflation, if you want to call it, where headline and core inflation is coming down. And that's really allowing EM central banks to ease well ahead of the Fed.
Where does the strength come from, though? And this is, coming at a time where we do see signs of weakness in Europe. We do see signs of weakness in a pretty significant way from China. And yet the U.S. has technology. It has the fact that U.S. consumers love to spend and travel, et cetera, et cetera. Where does the strength outside of the U.S. come from?
A lot of the strength comes from some of the reforms that emerging markets have really undertaken throughout the last couple of years. So many emerging markets have focused on trying to get their fiscal house in order. The COVID shock was a big shock, which meant that many countries had to really tighten their belts and really see where further structural reforms on the fiscal side, whether it's revenue mobilization or expenditure controls, can take place. And we can see that in a country like Mexico, which really has a very tight fiscal, but is growing extremely well, given the policies that it implemented over the last couple of years.
So you've mentioned Latin America several times, and you think that that is an area that has unappreciated benefits that have not yet been priced in from the U.S. strength, from the proximity, from some of this disinflation. Where specifically at a time where we're focused on some of the headline risk in places like Ecuador, Argentina, the mass devaluation, where are you seeing the opposite story?
So I think that, each country is very idiosyncratic. So, one of the countries where you are seeing positive developments is a country like Brazil, where you are seeing a central bank that is able to cut and is able to really take its path through the disinflation process with an economy that's still relatively strong and a political dynamic which is much more stable than it has been in the recent past. So those are some of the countries that are looking to be on a much more positive trajectory than in the past.
How concerned are you, just in a broader sense, of tourist flows? of people who kind of dabbled in emerging markets in the FOMO era that was 2 months ago, and now might be rethinking that in an era of American exceptionalism, evidently, which may last, I don't know, another 3 days. But my point is, how much are there fast flows that are going in and out of emerging markets that make it very difficult if you're looking in the short term at making some sort of tactical bet?
So I think the technical outflow last year when we saw the Fed hikes, that this year really the technicals have been a lot cleaner than going into other cycles. So that really limits some of the fast money flows that you're speaking of. So from that perspective, I'm less concerned. What we are seeing in some EMs are institutional clients looking to take advantage of the cheapness and the sell-off and really increase their structural allocations.
What kind of yields do you need to go into some of these countries at a time where you can get 4.3% on a 10-year treasury?
I think that's a fair point. And I think that it's not only just a matter of yield, but really your expected return once you adjust it for volatility over the longer term. I think emerging markets have a role to play in global portfolios, which is quite distinct from the old EM story. And that is a risk diversifier, particularly in investment grade emerging markets. So these are emerging markets that have solid balance sheets, are doing the right things from a macro policy framework perspective, and they're offering you excess yield over US Treasuries or bonds. And those are the countries that we like to focus on.
From an EM perspective, what are you listening for next week at Jackson Hole? How closely will you be listening to how Fed Chair Powell guides?
I think the key factor will be to what extent the U.S. economy is going to continue to be data dependent in terms of the Fed cycle, or whether there is an extent to which there may be concerns about the hard landing scenario coming back into question.
What does data dependent mean? We ask this all the time because you can focus on any data and craft whatever story you want. What does it mean for you to be truly data dependent?
I think it really means on how the inflation trajectory is going to develop in the U.S. as well as the labor market. We have seen reasonable strength in the labor market, but also some signs that there is slack emerging. So I think continuation of both of those trends are going to be what's important for the U.S.
Lupin Raman of PIMCO, thank you so much for being with us. At a really tumultuous moment, really, especially having to do with bonds. We're looking at bond yields that have just been surging, 30-year yields climbing through the highest levels that we've seen since 2011. Currently, they are continuing 4.4% off some of the recent highs. You saw the 10-year yield climb to the highest level going back to 2008, and we're looking at real yields driving the move. The real yield on the 10-year, adjusted for inflation, at the highest level going back to 2009. Coming up on Bloomberg TV at 2 p.m. Eastern, Tapestry CEO on the company's earnings and maybe some recent acquisitions as well. Right now, the S&P just managing to keep its head above water despite some of the concerns around the yield space, up 0.4%. The euro gaining versus the dollar, a bit of a dollar reprieve after several days of strength, and that 10-year yield, 4.28%. This is Bloomberg.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
We have been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
This is Bloomberg.
Wow, this bond market over the last month. Live from New York City this morning. Good morning, good morning. This equity market is doing okay, just about positive on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, global bond yields making new highs for the year. As the U.S. economy defies gloomy expectations, the Fed leaves the door wide open for another hike. We begin with the big issue, the ultimate pain trade.
Yields are probably going to be higher for an extended period of time.
U.S. 10-year yields are on their way up. Yields have been going up.
High for longer. Direction of travel for yields, in my judgment, is higher.
This range of, 4 to 4.5.
Up above 4%.
This configuration of a 5% Fed funds rate and a 4% 10-year Treasury, I think it's going to be pretty durable.
Closer to 4.5% before we go down lower.
The tendency will be for higher rates.
390 being the low end.
If you believe that the economy, is entering a soft landing, no landing, whatever landing you want to assign to it, that means rates have to move higher, not lower.
Whether 4% is good enough, I don't think so.
We're very bullish on fixed income as well, but you don't have to take a lot of risk in order to be successful.
We are in a different regime.
Regime that we were in pre-pandemic is gone.
I don't think we found the high end of the range.
It's the tendency for rates to be higher that I think most investors are missing.
Rates are high this morning, that's for sure. Joining us now to discuss is Bank of America's Megan Swiber, Neuberger Berman's Eric Knudsen. Megan, wonderful to have you with us again. Back in July, I think you said, and I've got the quote, the larger rate move was ahead of us. Was this the rate move you had in mind?
Jonathan, I think that it's fair to say that the move that we've seen higher in rates has really surprised a lot of investors at this point. And what I think really it's down to is two things. It's the resilience of the U.S. economy, as was kind of mentioned a bit in the open, and also this supply-demand imbalance that we're going to see in the Treasury market that we really see ultimately driving this bear steepening dynamic of the curve.
Let's talk about it, Eric. Is this move over the last month the one you were looking for, given that you were talking about stickier inflation the last time we discussed it?
Yeah, absolutely. Our view is that inflation was coming down, but was stickier than what was going to be stickier than what central banks and generally forecasters were expecting. That was going to lead banks to be, higher for longer. And that said, we think we think, the Fed's basically done from here. We do believe that we're trading towards the high end of the range from a 10-year Treasury yield standpoint, but that, it is likely that we will stay higher for longer on yields. The volatility has moved from the short end to the long end, and we think that's probably the single most important factor that we're watching right now is that risk assets trade off long end vol, not short end vol. So this is the move that's really important to watch here, and we think that there can be more long end volatility to come.
I've lent into this question a few times, Eric, over the last few weeks. What is the dominant factor behind the sell-off? Before we work out whether it's durable or not, we have to figure out what's driving it. What do you think's driving it?
Yeah, we think it is that long end volatility. You saw rate volatility was all concentrated in the short end for the last really year and a half, and now the long end is starting to reflect this uncertainty, both in terms of the change in the term premium and the likely need to change the R star or the long term kind of Fed dot. You look at the 25 Fed dots; they range from 2.4 to 5.6, and yet the long term dot is still at 2.5%. That seems like that needs to change. That would reflect a structural change in the long end of the yield curve. You add in the Bank of Japan, which needs to normalize rates at some point, and that is likely to untether longer portions of the yield curve in the U.S. and globally.
We'll be in Jackson Hole next week, Megan. This is something I imagine they're going to discuss. Do you think that's going to be the center of attention as well? Just where that long dot should be?
Yeah, Jonathan, I think it's been really the key focus, as was mentioned, for a lot of market participants at this point. As was mentioned, right, the Fed kind of has in their own projections right now this expectation that they can cut one day back down to 2.5%, 3% on Fed funds. And the market's really questioning that quite a bit at this point. And really, it ultimately comes down to the fact that the Fed has done so much already in terms of delivering those hikes. But yet the U.S. economy has held up so very well, specifically when we're looking at the labor market. So what it ultimately means from here, and I think the Fed is struggling with this balance of risks given the fact that they've delivered, in their view, enough hikes to get to the point where we should be feeling some of these impacts, where they are ultimately restrictive. What they're trying to do now is assess, given the fact that we've seen inflation fall really quite a bit, what are the risks to that inflation outlook when the U.S. economy has been so strong? So I think that at Jackson Hole, there's really going to be two points of focus. It's going to be what is the Fed ultimately looking for to decide how much more, if at all, they need to adjust the overnight Fed funds rate higher, and where are they thinking about where these longer run rates ultimately have to be, which the back end of the curve is really struggling with at this point.
The Jackson Hole get-together a week away. Let's talk about the back end of the yield curve right now. The 30-year higher by 5 basis points. The yield at the moment about 4.40. The 10-year yield higher by 3 or 4 basis points. 6 consecutive days of high yields on a 10-year maturity, right there at about 4.28. Let's call it 4.30. In the equity market, given what we've seen developing bonds, we're doing okay in stocks. We're positive here by, let's call it 0.27%, going into the opening bell about 24 minutes away. Yesterday, we had some Fed minutes. Matt Bozer's going to join us now to run through it. Matt, just how wide open is that door for another move from this Fed?
Well, I wouldn't say too wide open. Actually, we saw some signs in the minute that there's starting to be some fraying of the consensus around the need for higher rates. You actually had 2 Fed officials that the minute said would have favored actually no increase in July. And so you're starting to see a case building for, potentially an extended pause here. You look at the conversation around the labor market in the minutes, for example, they really see a slowing. They see wage growth coming down. They see job openings coming down. And it looks like they are starting to be pretty happy to accept some of the slowing trends that we're seeing there.
Matt, just how balanced are the risks going forward from here? I picked out this quote. I'm sure you've noticed it too. It was important that the committee's decisions balance the risk of an inadvertent over-tightening of policy against the cost of an insufficient tightening. Matt, what does that mean?
Well, I mean, we've all been waiting for this slowdown in the economy all year, right? And it just hasn't happened yet. So if you look at the minutes, they really are starting to expect that we're going to be seeing that any day now. I think that's the big question. Are we actually going to get that? At this point, the signs are looking pretty good for, continued growth, but that doesn't necessarily translate into higher inflation given the moderation we're seeing in wage growth, for example, the slowdown in hiring, even as initial claims, right, the layoff side of the picture stays low. So we might be setting ourselves up for a bit of a Goldilocks environment here, dare I say it.
Claims 239 this morning, not bad. Matt Boster, thank you, Matt. Appreciate it. Neil Datta of Renmark pushing back against some of this. Take a listen to this line. How can these people possibly know that the stance of policy is in restrictive territory? Neil went on to say this. This is an assumption they're making. I have a difficult time seeing how policy is restrictive when the unemployment rate is low and the economy is growing above trend. Eric, which camp are you in? The Neil Datta camp or the Feds?
We're in the camp that the setup is still fairly positive and supportive of risky assets in the short term. And then there is a serious risk that some of these, that higher rates, tightening credit conditions, the general tightness in the economy starts to bite. You look at the short-term positives, particularly in the U.S. economy, GDP now for the third quarter at 5.8%, bottoming in housing, bottoming in manufacturing, consumer spending still strong, consumer, various balances, liquidity balances still strong in the economy. It is expected that earnings are going to, flatten and then even start turning positive from here. So it's hard to kind of stand in the way of risky assets at this point. But we do think that over, whether it's 6 months out or 12 months out, that you are going to have to pay the piper in terms of higher rates and tightening conditions.
Megan, a lot of people have pushed back against this move, and the excuse I often hear from people is that you can't sustain rates above 4%. It's just too difficult. We've had 12 consecutive sessions of closing above 4% on a 10-year yield. What is it about this level that's difficult to sustain, do you think?
Well, Jonathan, I think that it's really, as we were talking about, the impacts of higher interest rates over periods of time, right? And what we're seeing and kind of focusing on in terms of risks for later this year into next year is the refinancing risk. So companies that have previously locked in very low borrowing costs, ultimately having to refinance that debt at a much higher interest rate level. And ultimately, our view is that is what can ultimately slow this U.S. economy down. But for now, the Fed has to balance the risks to the outlook right now, given that the data has really been so strong, which leads us to be more so in this higher for longer overnight Fed funds rate camp. And ultimately, we do think that the clearest way to trade this right now is fading the cuts that we see priced into the first half of next year.
How much more can we fade that? What's left of that, Megan, after the move we've seen in the last few weeks?
Yeah, and indeed we have moved quite a bit, as was also discussed, though a lot of that move has happened in the back end of the curve. I think really that's been sparked by these concerns around where longer term rates may be headed, and ultimately, again, kind of the supply-demand concerns that we see in the Treasury market, given the fact that the government has to be running very high deficits, and ultimately this Goldilocks scenario that we see playing out in the U.S. economy means that the Fed can do QT for a longer period of time. That also puts more supply ultimately into the market, making it harder for the Treasury market to digest this, particularly at this time when people are looking at these 4%, above 4% yields on 10s, 30-year rates, and kind of scratching their heads about whether or not we can continue to move higher at these levels.
Megan, is that what you and the team would say, just to jump in? Was it about that supply move that spooked this Treasury market by the Treasury a couple of weeks back? Not YCC at the BOJ, not the downgrade, right, but about Treasury just actually giving us a reality check and telling us how much more bonds they have to issue this quarter?
So I think it really was in part that reality check, but it's really a combination of all of these things, and they really do speak to one another, right? The BOJ yield curve control adjustment ultimately means that foreign investors will not be as inclined to be buying Treasury securities. The fact that the U.S. economy has proven so resilient kind of takes back and pulls back on the asset manager demand that we've seen be very strong in the Treasury market so far. And in terms of the overall supply picture, again, the resiliency of the U.S. economy means that the Fed can do QT for longer, and we can ultimately have more of these supply figures. So I'd say it's kind of a combination of all three of those things together. But I do think that investors are really struggling about what who ultimately is going to be the end buyer of all of these bonds, particularly when we're looking at levels that are going to be well above kind of what we saw fiscal year 21, 22 coming out of the pandemic.
Makes you wonder, Eric, why the equity market is so calm and comfortable with some of this. I know we've had a 2-day slide. I know we're off the highs by a little bit, by a few percentage points over the last few weeks, but it's not dramatic. And this morning we're still positive in the face of yields we haven't seen since 2011.
Yeah, I mean, and look, it's hard to get into a rates debate with a rate strategist. I'm a multi-asset PM, but another element here that is muddying the waters is the very strong level of fiscal spending that's still going on. This is an extraordinarily unusual setup where the central bank is tightening both rates and their balance sheet, and yet fiscal spending is still, very, very strong. It's another source of liquidity, and it's one of the reasons why it appears that short rates have had so little impact on the economy, and why we're so focused on long rates, in this environment. So again, it's in the near term, we just think it's very, very hard to have a very strong directional view at an overall market beta level, given these cross currents and the short-term positives, even with these longer-term negatives out there. And yet there are interesting things to do on the margin. In equities, we want to be biased towards quality stocks. We want to kind of broaden out our exposures so that as the market starts to broaden out, which we think it will over the next 3-6 months, as it has over the last couple months, our portfolios will benefit from that. And there's some interesting opportunities, say, to overweight Japan, underweight Europe, et cetera.
Eric, stick with us alongside Megan, breaking down this bond market and what it means cross-asset and beyond. Equities right now negative, or rather positive, by 0.25%. Treasuries negative, yields up on a 10-year by 3 basis points, 4.28. Let's get you some movers. Here's Abby.
Helping out that positive scene for stocks this morning, John. Cisco shares are popping on a solid quarter. They beat both top and bottom line estimates. Importantly, that means 16% and 42% year-over-year growth, respectively. So this old school tech company growth is back. Apparently, they're making good headway in AI and security, in addition to their more traditional networking business. Adobe up 2.2%, upgraded over a B of A. Speaking of AI, on their early signs of being an AI leader, now a buy from a neutral. And then Walmart up 0.7%, another top and bottom line beat there, beat earnings by 8%, sales by 1%. They've also raised the earnings outlook for a second quarter in a row. And apparently, John, the strength was grocery, but over the last couple of weeks, they're also seeing a recovery for general merchandise, which could bode well for the current quarter.
Interesting. More on the retailers a little bit later. Abby, thank you. Coming up, the White House growing even more concerned about potential spillover from China.
China made a set of different decisions, and because of that, I would agree that China does present a headwind, not just to the U.S. economy, but to the global economy.
That conversation up next.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
China made a set of different decisions, and because of that, I would agree that China does present a headwind, not just to the U.S. economy, but to the global economy. But we're better prepared to deal with that than any other economy in the world because of the policy choices we made here in America that are allowing our economy to grow, us to create jobs, while inflation is coming down.
Another warning from the Treasury about the difficulties in China following comments from President Biden, who referred to the economy there as, quote, a ticking time bomb. The currency there under pressure. And according to people familiar with the matter, Chinese authorities telling state-owned banks to step up intervention into the currency market this week in a push to prevent a surge in yuan volatility. Joining us now down in Washington, D.C., Bloomberg's Anne-Marie. MH, what's the latest on this front?
Good morning, John. Well, you see these worries continue to mount in Washington when it comes to the economic concerns surrounding Beijing. The latest being from our interview last night with the Deputy Treasury Secretary Wally Adeyemo. He went a step further than we heard earlier in the week from Janet Yellen, who said that China and the concerns there are a risk factor to the United States. He said this has to do with the set of policies made by the Chinese government. He still says the U.S. took different set of policy approaches, and that is why they are in better shape, and they should be insulated from this. Both still view this just as a headwind and think the U.S. in its current state will be able to counteract this. But at the same time, you could see that concern starting to rise. And it also comes, as you mentioned, President Biden took a big jab at Beijing, not just saying their economy, Jonathan, is a ticking time bomb, but also saying leaders of the Chinese Communist Party are bad folks. A lot of this rhetoric is going to amp up as we head into the November 2024 election, even as the administration is trying to create a lot more healthy dialogue between Washington and Beijing.
And apparently bad folks do bad things. AMH, thank you. Down in Washington, D.C. Joining us now is Megan Swiber. Eric Newson still with us. Eric, I heard this from Ben Laidler of eToro this morning, that China was an economic giant and a financial market minnow. Do I need to worry about the economic giant or just not be concerned with the financial market minnow?
Well, I think that you have to acknowledge the fact that it is an economic giant. We want exposure to China stocks and bonds in our broad global portfolios for both diversification as well as access to growth drivers and what can be, the number of world-class companies. But we're quite cautious on both stock and bond markets right now, given some of the concerns, some of the challenges that China is facing. And the way we're expressing this view is by we have been underweight the currency in our global portfolios. We have been expecting China to come in and take some measures, whether it's to try and stabilize the currency or to provide stimulus. I think that'll provide a short-term pop for the currency. We may take that as an opportunity to add to positions in underweighting Chinese currency, even as we maintain exposure broadly. We are evaluating the potential impacts of weaker growth in China and knock-on effects globally. But where we see the best opportunities in emerging markets is in emerging market debt away from China, where many of the central banks have already raised rates. They're in a position to be able to begin easing rates. We're getting a very attractive yield. We can mitigate a lot of credit risk in those countries, Latin America, some of the other emerging market economies, and that's where we see great opportunities.
We've seen those rate cuts coming through from Brazil, from Chile. Megan, just to finish on that, how are events in China as they develop influencing your thoughts about what happens here in the U.S.?
Yeah, so one thing that we've been really focused on here, John, particularly with regard to China, is the currency issue, right? So the very sharp appreciation pressures that we've seen on the USD relative to the Chinese renminbi ultimately is driving what we think, and as was mentioned, could be some currency intervention from the PBOC. And while we haven't really seen any notable actions from them yet in terms of selling U.S. Treasury bonds, ultimately that is one way that they can help stem some of the depreciation pressure that they've seen on their currency. We certainly saw this very extreme example in 2015, and that is a risk here. And we've seen a lot of questions from clients and investors this past week come in on the back of that, given the fact that China is such a tremendous holder of Treasury securities. Ultimately, what this means is if they do indeed sell bonds to help defend their currency, is that you could have more upward pressure on the front end of the rate curve, which is still endorsing our view that you want to keep those underweights at the front end of the Treasury curve.
Megan, just to build on that, just a touch, one extra question, if I may. Do you think in any way, shape or form, what we're seeing take place in Treasuries now is somehow connected to what's happening there?
Well, it's all the same backdrop, right, John? So when we're talking about the supply-demand concern, what we know is that really foreign investors more broadly, when you're talking about the private investors looking at treasuries relative to their own local curves, or the official sector, which is their buying and selling of treasury securities is very much so determined on dollar pressures. It really paints this picture of a struggled supply-demand backdrop from the Treasury curve. And the way that you see that play out most specifically when we're looking at price action is indeed that bear steepening of the curve. And that is kind of exactly what we've seen play out over the past couple of weeks.
Interesting, particularly the note on currency intervention as well, and what could happen with Treasuries. Megan, thank you. Megan Swiber there. Eric Newson on the latest. Coming up, the morning calls and later. iCapital's Anastasia Amoroso expecting a challenging month of September to fuel further downside for stocks. That conversation just around the corner.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Minutes away from the opening bound. No drama in this equity market. Drama in the bond market, but stocks okay on the S&P, just slightly positive. That's the price action. Here are some morning calls for you. First up, Bank of America upgrading Adobe to buy. 630 price target, saying the company is emerging as a front runner within the AI race. Next up, Oppenheimer raising its NVIDIA price target of 500, expecting the company to benefit from broad and robust AI demand. And finally, Morgan Stanley raising its Cisco price target to 56, seeing signs of improving demand despite the challenging macro environment. That stock is up by 2.4%. Coming up, iCapital's Anastasia Amoroso expecting a rocky September to bring the dip buyers out in force. That conversation up next. Your opening bell just around the corner.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Support on celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
Authorities.
Could face bigger challenges next.
Was going to keep rate World Cup.
This is a 3
as the economic picture down.
Is it the OK's getting ready to make a decision?
Given what is happening in the bond market, I think stocks are doing okay. Given what's happening in the bond market, equity futures just about positive on a two-day losing streak on the S&P 500. Futures here are up by 1/3 on both the S&P and the Nasdaq. Still poised, though, for a third week of losses. There's your opening bell. This is what's happening in the bond market. Yields are higher on a 10-year for a sixth consecutive session, higher by 3 basis points. On a 10-year, 427.81. New highs this morning for 2023 on a 30-year. New highs for the cycle, the decade. You've got to go back to 2011 for yields that high. In the FX market, the euro holding on 109.10 on euro dollar right now, positive 1/3%, and crude holding on as well, $80.60. We're up by 1.5%. One stock to watch at the open is Walmart, raising its annual outlook for a second straight quarter. The CEO saying this: we're in good shape with inventory and like our positioning for the back half of the year. We're gaining market share as our value proposition continues to resonate both for value and convenience. Abby has more. Hey, Abby.
Hey, John, and this is the second quarter in a row where they have raised guidance. So very impressive results from Walmart. In terms of the quarter that they just reported, they beat bottom line estimates by 8%, sales by 1%. These are not small numbers either. They put up revenues of $161.63 billion. That's really pretty incredible. Adjusted earnings of $1.84 per share. And in terms of the outlook that they raised it by a couple percentage points. There was also growth in the quarter that was grocery is the main driver for this company, but they're seeing in recent weeks some strength for the general merchandise. So they are somewhat positive. Now, what's interesting, we do have the stock higher, although at this point it's up just about 0.2%. One reason could be the shares really priced for perfection. Coming into today, the stock was up on the year by more than 10%. Its closest competitor, Target, down more than 10%. So investors might have wanted a little bit more, even though this was a very clean quarter and a nice guide.
Abby, thanks for that. This headline from Walmart got my attention, that they see headwinds coming from U.S. student loan repayments, even with this so-called 12-month on-ramp, which basically means you don't have to start paying straight away. Target said something similar yesterday. The CFO said the resumption of student loan repayments would, quote, cause additional pressure on already strained consumer budgets. We're going to catch up with Coward on this in about 10 minutes' time. Look out for that conversation. Let's stick with retail earnings. Tapestry posting weaker than expected results on softening U.S. demand. The CEO touting its recent acquisition of Capri, saying the following: we're establishing a new powerful global house of luxury brands that reaches across consumer segments. Simone has more. Hey, Simone.
Hey, John. Yeah, the parent of Coach and Kate Spade missing on earnings, missing on revenue estimates for the fiscal fourth quarter. That's ended July 1st. But even worse is potentially the outlook for its next fiscal year ending June 30th, 2024. Seeing adjusted earnings per share of $4.10 to $4.15. The street had been looking for $4.22. Seeing revenue of $6.9 billion. That's up 3-4% from the year, but lower than analysts had anticipated. And even this, going to be driven by international, the much smaller piece of its business, because the U.S. makes up about 60%, and that is going to be up only slightly, according to management. Now, this doesn't include the impact of that deal that was announced last week. It's expected to close next year to buy Capri, but that's going to be a struggle as well, as the company's going to have to find a way to reduce its leverage ratio. One bright spot, though, and maybe this is what the market is reacting to here, is that it does see high single-digit growth from Asia and China. That is a large part of its international sales and a place where there is potential to sell Michael Kors. That is one of those Capri brands.
That stock is up by 0.8%. Simone Foxman there on the story. Let's stick with earnings. Cisco, the shares are moving higher after delivering results that point to resilient demand. The CEO, Chuck Robbins, focusing on the company's AI potential, saying, quote, "This is a huge opportunity for the company. We're laser focused on leading and winning in this space." Ed Ludlow, you know the cheat guide if you're a tech firm. Just mention AI.
Yeah. I mean, the story is AI. The shares for Cisco up 3.8% on an intraday basis. That's the biggest jump going back to February. What Cisco said is that they'll be a leader in AI, but they gave tangible evidence that they're already doing that, saying that they booked $500 million in revenue already for their AI-related products. The broader story is that as the hyperscalers move quickly to add more compute for those firms that are working on large language models, they will need the associated data center networking gear, and in Cisco's case, the software that goes with it. Cisco didn't quantify that, though. There's no sort of like, here's the dollar opportunity for us in AI, but they did give evidence that so far they've booked strong sales on it. Remember the other story for Cisco, though, John? They just closed out the fiscal 23 year with 11% year-on-year growth. A lot of that is to do with the component shortages that Cisco experienced through the prior year, and then making up some of that demand that was built up. They were able to get hold of components and sell them. Then it's a different story looking at fiscal 24. We're in the first quarter of their fiscal 24 period, which ends in October. The guidance that we got is that sales will be $57 billion to $58.2 billion in fiscal 24, just shy of the average analyst estimate of $58.3 billion. But if you look at the sell side notes, I think loads of people are quite sanguine about that. 11% growth in the last fiscal year, less than 2% for fiscal 24, but things are normalizing. And something that Chuck Robbins did really sort of effectively is transition Cisco from a kind of legacy tech name that booked sales with big contracts to recurring revenues. Then I go to gross margin on an adjusted basis, 65 to 66% for this current period, above expectations. They're doing well at making money, both from the hardware and software components of their business.
I know this is going to be a feature for you guys a little bit later. Look out for Bloomberg Technology with Ed Ludlow and Caroline Hyde. Ed mentioned what was happening on the south side. The stock, by the way, up by close to 3.7%. This is a view from Jefferies. They reiterate their buy after the earnings. They write the following: quarterly results and guidance look solid, particularly in the wake of fears about the organization would meaningfully cut its outlook for 2024. Their commentary about the macro environment was sensible and incrementally positive. That stock is now higher by, let's call it, 4%. Final story for you. Shares of Hawaiian Electric, they remain sharply lower, falling for an 8th consecutive session after the Wall Street Journal reported that the company is speaking with restructuring firms to address their financial and legal challenges due to the wildfires in Maui. Katie Greinfeld has the story. Hey, Katie.
Hey, John. Yeah, Hawaiian Electric shares absolutely cratering this morning, currently down about 25% from the bell after, like you said, that Wall Street Journal reporting that the company, the utility company, is in talks with restructuring firms to address the multitude of financial and legal challenges that it's facing. For context, of course, Hawaiian Electric supplies power to the bulk of Hawaii's residents, and as a result, it's facing questions over what role its power equipment played in the Maui wildfires. And now, according to the Wall Street Journal, it's in discussion with whether it needs to hire advisors, given that its legal costs are adding up, just as its access to capital becomes more challenged. Remember, of course, on Tuesday, S&P downgraded Hawaiian Electric to junk status. And needless to say, shares have plunged throughout all of this, currently down more than 70% over the past 8 sessions alone. And today looks down like we're down another 25%.
That is a tough situation, that's for sure. Kelly, thanks for the update. Kelly Greifeld there on top of the story. About 7 or 8 minutes into the session, the broader market positive here by 0.25% on the S&P. The Nasdaq just about positive as well by 0.1%, 0.2% higher. iCapital's Anastasia Amoroso expecting stocks to take their cue from 2 key events next week. Unless Nvidia or Jackson Hole save the day next week, there's most likely more downside to go, likely another 3% lower from here. But if we get there, stocks should be a buy, because even though rates are higher, resilient economic growth should offset that. Anastasia Amoroso joins us now. Anastasia, great to catch up with you. Let's start there. Where would be a buy? Where specifically would you look to buy?
Sure, John. Well, the reason I'm looking for about a 3% downdraft from here still is because we now broke through some key moving average levels, the 50-day moving average, and then also the short-term CTA threshold. And if you look at what would be the next sort of reasonable stop for people to step in and potentially buy, it would be a 100-day moving average. And as I mentioned, that's about 3% lower from here. You know, I think that would be a pretty good value given that we've got the S&P that at that point will have corrected by 7 or 8 percentage points. But then I wouldn't just broadly look at the S&P. I would look at some of the semiconductor stocks. I would look at some of the artificial intelligence stocks. And some of them have corrected probably at that point by 15 or 18%. So, you know, given that so many investors probably have wanted to participate this year, but maybe missed that first half rally, I think given anywhere between 10 to 15% pullback on some of those idiosyncratic stories, that would be a great entry point.
What about the rate story, Anastasia? I imagine you get asked that question a lot of times. Can we live with 4% on a 10-year, 440 on a 30-year?
Yeah, I mean, I actually think we can, because if you think about it, John, you know, what's driving the 10-year is a little bit different than what's driving the 2-year. You know, the 2-year, for the most part, it's all about what the Fed is going to do in terms of rate hikes or rate cuts. And if you think about the 10-year, it's, of course, the level of rates, near-term rates, but it's inflation expectations, and it's also growth expectations. And the reason why the 10-year has been rising and the yield curve has kind of been re-steepening is because we've actually got the third quarter GDP that's apparently on pace for 6%. We'll see if that actually sticks around. But either way, the reason why the 10-year rate is moving higher, part of the reason is because growth expectations are also picking up. And if that's the case, then that's a pretty good offset for stocks that, yes, they have to grapple with a higher level of interest rates. But if that means higher growth, higher top line growth and earnings growth, that offsets it.
Anastasia, you mentioned 2 themes for next week. One was NVIDIA. The second event was Jackson Hole. You mentioned it again there. What would you expect to hear from Chairman Powell next week?
Yeah, I don't really think that we're gonna hear a big change in narrative. I mean, if you look at just the theme for next week's Jackson Hole, it's not sort of the what's happening in the economy right now, but what is happening structurally with the global economies. So I think they're likely to take a look at supply-demand imbalances in labor markets, for example, you know, the fiscal stimulus around the world and what that's done structurally to inflation. But these are not going to be kind of near-term policy decisions of what they may do with rates next month. I think the most important event, you know, for that will be the CPI inflation print that we get on September 13th. And I don't think really Fed Chair Powell is going to talk about that, but the FOMC participants should be looking at the last 3 months worth of data. And if you look at the super core inflation on both services and goods, it's annualizing just about 0, you know, on a last 3 months basis. But again, I don't expect that really to come up, you know, Jackson Hole next week, because I think we need to look for September. But really, that leaves the other huge event for next week, and that is NVIDIA. You know, if NVIDIA does deliver, I think it reinvigorates some of the tech stocks, and if it doesn't, obviously that's a catalyst to watch.
Well, they delivered big time last time around. Anastasia, thanks for the update. Anastasia Amoroso there of iCapital on this equity market. We are about 12 minutes into the session. Equities are doing okay, positive by 0.25%. Coming up, Walmart lifting its outlook for a second straight quarter.
Walmart keeps putting up better margins than expected. They're getting the traffic, they're getting the sales on the top line, and, you know, they really are getting the profitability they need to drop to the bottom line.
We'll be breaking down the results with Cowen's Oliver Chen. That conversation up next.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
Walmart keeps putting up better margins than expected. They're getting the traffic, they're getting the sales on the top line, and, you know, they really are getting the profitability they need to drop to the bottom line. It just seems that the consumer has been more resilient than I think a lot of us have given credit at this point in the year.
Big time. I think we all agree on that. That was Telsey Advisory's Joe Feldman reacting to Walmart's latest earnings report. The retailer topping Q2 estimates and raising its outlook for a second consecutive quarter. The CFO saying this: we had another strong quarter. Around the world, our customers and members are prioritizing value and convenience. Bloomberg's John Edwards joins us now to discuss. John, I was talking about this earlier on this morning. If the earnings are good for Walmart, what about everyone else?
Yeah, well, Walmart is taking share from a lot of its competitors, and so it's not, Walmart's success is not necessarily raising other boats, but what we're seeing is, they continue to be in sort of a sweet spot here where they are appealing to the value-conscious, sort of lower and middle-income shoppers, but also getting people, from upper income categories who are trading down and finding that they're appreciating the selection and the values at Walmart there. So, you know, it's an interesting situation, too, in that, you know, they did raise their outlook, but it's a little bit of a backward-looking raise, if that makes any sense, because they continue to be cautious about the balance of the year. You know, they're saying that, you know, the increase in the outlook is basically because they've done so well that they had to increase the numbers for the full year. But they're still making some cautious noises about how consumers are going to hold up in this quarter and the next. So we'll see how that goes.
Flagging student loan repayments as well. I saw the same thing. John Edwards there on the latest. Yeah, John, thank you. The stock is up by 0.7%. Cowen's Oliver Chen weighing in on Walmart's results, saying this: Walmart was impressive with stronger results in general merchandise relative to prior expectations. Overall, health and wellness continues to lead comp sales. He maintains an outperform rating and 180 price target. Oliver, I'm pleased to say, joined us right now. Oliver, how about that? And good morning to you, sir. What do you make of the guidance? And how many headwinds are out there going into the end of the year?
Yeah, we're excited for the beat and raise. It was an all-around good performance from Walmart. What's really working here is grocery as well as everyday low value. The grocery comps were up high single digit. It's been a much tougher situation for Target. You know, as we've mentioned, consumer discretionary at large is under pressure. Target is much more exposed to consumer discretionary, and consumer discretionary trends were a little bit weak at Walmart as well, but we're impressed with what they delivered here this quarter. The consumers are looking for value. They're being choiceful. They do have spending power, but as you mentioned, student loan exposure, it's about 17% based on our survey work at Walmart and 20% at Target. That being said, there is a one-year grace period from which, you know, some of the student loans won't damage your credit in terms of the grace period. So that's something to watch as well, John.
Oliver, I was thinking about the same thing. There's a 12-month on-ramp. How do they know? Yeah. This feels like an excuse in the oven for 3Q. Is that what it feels like for you? Just lower the bar a little bit.
Yeah, I think the cautious optimism, they are expecting a decelerating revenue growth in the back half. Our take is that could be very conservative. What we see in the numbers at Walmart is pretty balanced performance from traffic and ticket. Having positive traffic is very good. The comments on back to school at both have been very constructive as well. So as long as Walmart plans for everyday low prices, which they do very, very consistently, that's a key positive. Second point, they're getting higher income consumers. That's a key positive. They're also very focused on convenience. Think about curbside pickup. Think about ordering online. You don't even have to go into the Walmart store to really benefit from this entire ecosystem. The other important point, John, is this digital revolution. So Walmart CEO mentioned artificial intelligence and generative AI. That will play a big role in the future of retail. And we've done a lot of work on computer vision, specifically inventory management and inventory recognition. It's all happening in retail right now.
Oliver, you mentioned the high-income groups trading down. Can we just sit there for a moment? We've seen weakness in luxury in North America. We know there was a luxury watch boom through the pandemic. That's fading pretty quickly. Oliver, what's happening with the high-income groups in America, that high-income consumer?
Yeah, the high-income consumer is seeing cross currents, specifically the aspirational consumer. In terms of that consumer that's shopping for entry-level luxury, that's a little bit weaker. And even though the Tapestry numbers, North America has been tougher. So that is something to watch. Also, John, everybody's traveling, so that's taking share away from tangible goods. On the other hand, we're seeing still solid results from Asia and China in most categories, so that's quite a positive. And at the very high end, that consumer always has a lot of money, so it becomes quite emotional. The very high end remains very strong, and some incredible price raises at Hermes, Brunello Cucinelli, Chanel. That high end is working quite well. So a mixed picture, but overall, luxury goods is a great place to be. As you know, my top stock ideas are Louis Vuitton, as well as Costco and Walmart, thinking about that barbell at the high end and customers looking for extreme value as well. And Costco has a higher income customer too.
That weakness in North America, I saw it in Richemont numbers. I think I saw it from LVMH as well. Oliver, do you think that changes as we loosen up some of the travel rules around group tours from places like China to the US, to the UK? Does that change things for the US and North America?
We're hopeful, but regarding China and travel, visa restraints will be a limiter in terms of that. And also, it will be slow and phased in. In terms of the Chinese tourism, John, it will happen most close to China in terms of Japan and Korea. That's happening now, and a little bit later to Europe and the US. But that is a longer term opportunity. In the near term, we are still cautious on this U.S. consumer, the aspirational consumer. Inflation is distracting to everybody, and that's taking money away from other purchases, as well as consumers going out again. There are bright spots such as beauty, health and wellness. Those have been great categories, and they're very consistent with going out. Thinking about cosmetics and investing in your face is very important.
And LVMH, Walmart, Barbell. Oliver, thank you. I agree. Investing in your face is very important. Thank you. Oliver Chen, thank you very much on the latest. I didn't miss that. 23 minutes into the session. Equity's just about positive with some sector price action. Here's Abby.
Hey, John, it's going to be interesting to see whether or not we have another bearish reversal on the day because we are off the highs, but to your point, a small gain here for the S&P 500. So not surprisingly, more sectors are higher. Energy leading the way, up 1.9%. Materials, communication services also up there. To the downside, though, we're looking at healthcare, consumer discretionary, and tech. As for that energy strength, it really is pretty impressive, up 1.9%. And we have both ExxonMobil and Chevron participating. I believe this sector, John, is higher on the year. I will have to confirm that another time, but it really a comeback for the energy sector.
You can check in a break. Abby, thank you. Your trading diary up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
26 minutes into the session, we're just about positive on the S&P 500. That's the price action. Here's the trading diary. More earnings coming up later. Dear earnings coming before the opening bell on Friday, plus another read on the consumer with Estee Lauder numbers as well. We round out the week with Eurozone CPI on the data front next week. Just a sneak peek of next week for you. The president heading to Hawaii to assess the damage in Maui. And finally, you'll get the Jackson Hole Summit, the get-together for the Federal Reserve next week as well. Full coverage coming from us. And that first Republican debate in the mix too. So busy week next week. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, Matt Miller is off today. God forbid. I think it was 3 days in a row he worked. So we got Jess Menton in here filling in for Matt. That's a good thing. Coming up, we're going to break down some economic data coming out. The leading economic index came in right in line with expectations, a little bit better than last month. So that's a good thing. Carl Riccadonna, chief U.S. economist at BNP Paribas. He's going to join us, give us his thoughts on the U.S. economy and how concerned should we be about China. And then Regina Schleiger, director of Central Bank Policy Research at SGH Macro Advisors, joins us to discuss the Bank of Japan ahead of CPI tonight, another central bank policy. That's all coming up. But right now, let's kick things off with Denise Pellegrini.
Yeah, we're looking at that Conference Board leading index you mentioned for July. Also, U.S. weekly jobless claims coming in at 239,000 last week. The estimate was 240,000, so that also pretty much close to a match, you might call it. And some say the big question is when? Do these rising bond yields really suck the air out of the room for stocks? We're not seeing it yet, but we might be seeing some signs of it. The yield on the 10-year right now, 4.29, creeping really close to 4.3% right now. The Dow, it is up 0.3%, up 96 points. The S&P 500 up 0.2%, up 7 points. The NASDAQ, though, it is down now, down more than 0.1%, down 18 points. Spot gold right now up about 0.2% at $18.95 an ounce. Crude oil right now up 1.4% on NYMEX crude at $80.49 a barrel. Shares of Walmart, they're higher, trying to be higher by 1%, not quite there yet. Walmart raising its annual profit forecast. This is for the second straight quarter they've done this. They're still talking about scoring new sales gains with bargain hunting U.S. shoppers, a lot of trade down shoppers, middle class shoppers trying to kind of take the edge off inflation there. Walmart says it's still gaining market share at all income levels, proving that point. That's according to the CFO. But the CFO also says there is uncertainty in economists and in the economy for the rest of the year. So that's one area of concern. And shares of Tapestry, that's another retail-related stock. They're slightly lower. Their net sales came in lower than expected, and their earnings forecast for the year also lower than expected. We'll get Ross Stores after the bell. So a lot of retail and consumer stuff to keep an eye on today. Of course, we've got the big Fed meeting next month. That's what everybody's looking at. And that's a Bloomberg Business Flash.
All right, Denise Pellegrini, thank you so much. We appreciate it. Jess Met and Paul Sweeney here in the Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so just head over to YouTube.com and search Bloomberg Radio, and that'll get you where you need to go. Looking at this market, a little bit of red and green, as Denise was just reporting. Let's break it down, do a little extra stuff. He's got some economic data out there as well, so we're going to bring it all together here. We're going to check in with Alex Semenova. She joins us here in our Bloomberg Interactive Broker Studio. She covers all the markets for Bloomberg. And Dana Peterson, chief economist at the Conference Board, also joins us on the phone. Dana, let's start with you. The leading economic index came in at negative 0.4. That's right in line with expectations, but better than last month. So what are we seeing here? What do you take away?
Well, yes, the month-on-month change was a little bit better than last month, but when you look at year-on-year and even the 6-month moving average, it's still declining, and it's still signaling that there may be a recession on the horizon at some point.
So this has been in decline for 16 consecutive months at this point. So what would that tell us about the direction of the economy? And when the back of we've seen better than expected data when it comes to retail sales and things like that.
Well, it's definitely telling us that a slowdown is in the future. How much is the question? Do we actually go into a recession, or do we have just a soft spot? Our forecast is still that there's a recession probably starting in the fourth quarter of this year, lasting until the first quarter of next year, but short and shallow, not too bad, but certainly these data are pointing in that direction.
So what's the catalyst then?
Well, there'll be multiple catalysts. First off, consumers. Consumers are running out of excess savings. They're also ratcheting up on debt, and that debt is coming at a higher price because the interest rates are rising really aggressively with the Fed funds rate. And so those things, plus the fact that anyone who has a student loan is probably going to have to start paying it in October, those things are going to weigh on the economy. And the other piece is businesses. So businesses are probably going to start ratcheting down on investments and potentially pulling back on hiring to reflect the fact that borrowing costs have elevated.
And Dana, just, it's interesting to put that recession call in context with a job market that's still pretty darn strong. The initial jobless claims today came in showing, a decline from the prior period here. How do you square that peg a little bit with, a seemingly strong economy, yet some concerns about a recession?
Well, it's interesting. When we ask CEOs what they're thinking of the biggest companies, they continue to say 84% of them think that there is going to be a recession over the next 12 to 18 months, but they're still hiring. 40% of them are hiring people, and 40% of them are hoarding laborers, and only 20% are actually letting people go. So there is this cognitive dissonance here.
All right, Dana, thanks so much for joining us. Dana Peterson, chief economist at the Conference Board. I want to bring in Alex Semenova. She's the Bloomberg Equities reporter. Give us a sense of what's happening out there in this market where on the index level, a little bit of red, a little bit of green out there. Alex, what are you looking at?
Yeah, it's been really interesting to see this big change in sentiment in recent weeks where we saw a lot of recession forecasts pushed out to 2024. JP Morgan was one of the first to say that they no longer see a U.S. recession. And at first, that was driving optimism among investors, the prospect of a soft landing, averting a recession, inflation coming down. But now it seems to be the case that investors are actually worried that if we don't get this recession, that we're going to see an uptick in inflation. And the focus is now on higher for longer interest rates. If we don't see any kind of economic downturn, then there's upside risk to inflation kind of resurfacing. And the Fed pushing rates even higher. We saw that again with the Fed minutes yesterday. A lot of policymakers were concerned about persistent cost pressures and considered the prospect of further rate hikes later this year.
And speaking of the consumer, we did hear from Walmart this morning with their earnings. What are you seeing with that stock? That's ticker symbol WMT, down about 0.4%.
Yeah, so Walmart shares were pretty much fluctuating all morning. That's after the company raised its annual profit forecast for the second straight quarter, thanks to new sales gains gains among U.S. consumers who are seeking out bargains as higher costs still weigh on their budgets. Chief Financial Officer John David Rainey said the consumer is still spending, however, they're being more discerning about where they're spending, and Walmart is a beneficiary of that. Of course, they have more budget options when it comes to their groceries and merchandise. Grocery revenue continued to climb. So did its general merchandise business. It was stronger than the company expected. The retailer is still benefiting from steps-up demand among higher income consumers and its e-commerce business.
Yeah, Dana Peterson had just pointed out when it comes to the student loans this fall, those repayments. If you look at Target CFO, he had actually flagged that was one of the concerns amongst them, but still seeing some inventory as far as the pain Target went through. Those are better than expected. So the back-to-school shopping season, Alex, especially when it comes to Walmart, I feel like that's really holding up some of these retailers heading into the holiday quarter, the final months of the year.
Absolutely.
Yep, absolutely. One more stock I want to just get a handle on, Cisco on the tech side. They had some numbers out, and stock's kind of reacting pretty well today.
Yeah, it was up more than 4% last time I checked. That is the best move since February. That's after the company posted better than expected earnings and also reassured investors that it could weather a slowdown. It touted its AI capabilities. I want to read out some of the analyst commentary. Morgan Stanley called Cisco's results a pleasant surprise given an otherwise volatile earnings season in the networking space. Jeffrey said that Cisco's results looked particularly solid in the wake of fears that the organization would meaningfully cut fiscal 2024 expectations. So it seems that the bar was pretty low for Cisco, and they delivered, and analysts are pretty excited about it.
All right, stock's up 4.6% today, up 16% year to date, 52-week high. So good news for the good folks at Cisco. Alexander Semenova, Bloomberg Markets reported. Thanks very much for that. We appreciate it. All right, our next guest, I guess I got to call him like my favorite economist, but that's not saying a whole lot, quite frankly, but he is good, and we're glad we got a few minutes of his time. Carl Riccadonna, he's BNP Paribas now. I trained him up here at Bloomberg Intelligence for many years, but he's pretty solid. Carl, what are you looking at today? We just heard from the good folks, Dana Peterson at the leading economic indicator at the Conference Board. They still have a recession call out there. How about you guys at BNP Paribas?
Well, Paul, I should back that up. You taught me everything I know, of course. So, thanks for that. I'll start with that. But in terms of the recession view, we still see some pretty ominous factors looming on the horizon. You've been talking about the resumption of student debt payments. Right. Now we can, there may be some wiggle room here that you have a 12-month grace period, to start and whatnot. But if we just look at the view from 60,000 feet, the price tag on that is about $100 billion annualized. So look back to Q1 when everything went haywire with the cost of living adjustment and Social Security. That was also about $100 billion price tag. So I'm sure they're not equal, but when you look from when you squint from a distance, they're of similar sizes. And so all of the things that went up in Q1, discretionary spending and whatnot, we could see kind of a similar fallout in the Q4 period. But on top of that, you have a very divided government that has to pass 12 appropriation bills by the end of this month, or by the end of September, rather. That seems very unlikely. So there's a risk of a government shutdown then. The excess savings story, we've been focusing on this. San Francisco Fed wrote on this recently. Those savings are rapidly being eroded. You see that in the retail earnings you discussed in the earlier segment, where Target is noticing the price sensitivity of consumers, and Walmart sees a lot of the higher end consumers walking into Walmart to go after those bargain prices and whatnot. So you kind of see that playing out, so there's a bit of a perfect storm, I think, coming about in Q4, which still makes me worried about elevated recession risk in Q4 and into the kind of first part of next year.
How do you square that away when a lot of this data still is pretty resilient if you're looking at retail sales, even the Atlanta Fed's GDP now for the current quarter up around 5%. Yeah. And when you're talking about Walmart coming in and better than expected outlook on the consumer, as far as you talked about student loans, I mean, what's the main catalyst here to really weigh on consumers when we're looking at the difference between spending when you're talking about obviously goods versus services?
Well, I think the GDP tracker in the at the early part of the quarter can often go for a real loop, and I think that's what we're seeing at the moment. I highly doubt we're growing at 5% in the current quarter in inflation-adjusted terms. So I value the Atlanta Fed GDP Now tracker.
It can be volatile.
Follow it, but it does move. It does move over the course of the quarter. That's not unusual, and so I do think we'll see some moderation in that indicator over the course of the quarter. That being said, there is a theme of resilience here, whether it's the labor market or consumer activity and whatnot. But you always have to be looking forward, and you're hearing those anecdotes of price sensitivity from consumers. So the real test will be if this can hold out over the course of the quarter, or if July just happened to be a good month for retail, whether weather was driving people into shopping malls or Amazon Prime Day, or a lot of these factors, maybe just one-off developments. When we kind of step back and look at the macro fundamentals, the broader GDP trend, so not the quarter-on-quarter change that we see in the GDP Now forecast, but rather the year-on-year rate of change is slowing. What does disturb me is GDI, so gross domestic income, which in a perfect world should track in lockstep with GDP. But the guy who taught me everything I know, Paul Sweeney, don't live in a perfect world. And the GDI numbers look pretty bad. So gross domestic income, well, first of all, profits are slowing, and gross domestic income looks pretty lousy. We'll see the next print on that when we get the second print for Q2 GDP. But GDI is a pretty disturbing trend. So there's definitely fodder for both sides of the debate here, and I'm not convinced of the reacceleration narrative just yet.
We've certainly seen, Carl, over the last, couple of weeks, some really disappointing economic news come out of China. How do you kind of think about that as you think about the impact of the U.S. economy?
Well, China's obviously a very important trading partner, and global commodity prices are very sensitive to the health of the Chinese economy, and those commodity prices impact the U.S. inflation outlook. So, we're definitely watching the situation very closely and trying to understand what's happening, in the kind of immediate reopening after COVID, and then, where things settle there. There seem to be some key differences. So, in Europe and the U.S., we saw a lot of pent-up savings and pent-up demand that really led to the, kind of revenge spending and house price appreciation and demand for a lot of consumer spending categories. It looks very different in China, and we're seeing that play out. That the reopening of the second largest economy in the world looks very different than what we've seen in the U.S. and Europe. And we're seeing that pass through to supply chains, and this is feeding into an inflation narrative of deceleration. But our view has been at BNP for quite a while that the last mile is going to be where the real toughness comes out, and the real stickiness of the inflation data is apparent, and that's going to mean that this Fed can't. We'll have a course correction on the immaculate disinflation narrative, and the Fed is going to have to remain vigilant in its inflation fight to get us all the way back to 2%. It's easy to get from 9% down to 6%, right? But getting from 6 to 4 is harder, and getting from 4 to 2 is where it will really take some softening of labor conditions and some of the categories that have been sticky to really move lower.
All right, you brought up the Fed. We do have Jackson Hole next week. How do you view this, and what this could potentially mean for their signaling ahead of that September 20th decision?
I don't think they're going to signal much for the September decision. Of course, they'll be asked in the press conferences and media exchanges and whatnot what they're thinking, and I think they'll give us the generic Fed answers of, well, there's more data to be seen, so we don't want to cast a judgment.
Well, we did get the employment cost index, CPI, PPI, and then PCE since the last decision. So it feels like those Fed minutes we got yesterday might be a bit backward looking, right?
That is spot on analysis, because people are focusing on some of the hawkish language that was in the minutes, where they said there's still upside risk to inflation and therefore we may need to do more. We have to remember they wrote those words, and then we got a cooler CPI report, a cooler ECI report, a still hot but cooling trend in the labor data. right? So that dates some of that language. And I think the more important takeaway from the minutes was that they're looking at this in a very two-sided fashion now as they assess risks for the outlook, doing too much, but also doing too little. Whereas before they were always kind of worried they were behind the curve and were just focused on catching up. So this is a different, more thoughtful, more data-sensitive Fed going forward. I think this may mean that they're on hold, and in fact, they may have been at the peak rate of the cycle at the July meeting, and they're done now, even though they don't want to say mission accomplished.
Right. All right, Carl, thanks so much for joining us. Always appreciate getting your perspective, your analysis. Carl Riccadonna, one of the best. He's a chief U.S. economist at BNP Paribas. We'll have more coming up. This is Bloomberg. All right, let's go to Lisa Mateo. She's got some company news.
Good morning. Walmart is winning new sales gains with bargain-hunting U.S. shoppers and increased demand from higher income earners. Bloomberg's Gina Cervetti reports.
The retailer's key sales metric in the U.S. rose by almost 6.5% last quarter, and Walmart raised its annual profit forecast for the second quarter in a row. An executive said that food revenue continued to rise strongly, and the general merchandise business was stronger than Walmart expected.
Now, shares of Walmart right now are down about 1%. Meanwhile, Children's Place says it's going to close about 80 to 100 stores this year. The company also reported adjusted loss per share for the second quarter. Shares of Children's Place right now, well, they're up about 9%. And Aldi is making a supermarket sweep through the South.
The discount food store is buying Southeastern Grocers, the owner of the Winn-Dixie and Harvey's supermarket chains. The deal includes about 400 locations. Aldi will evaluate each store to decide which ones will be converted to its format. The remaining ones will continue to operate as Winn-Dixie and Harvey's stores, a significant change in Aldi's business strategy. The companies don't say what Aldi is paying.
And that was Bloomberg's Steve Potisk reporting. And Bloomberg has learned that mass production of Tesla's revamped Model 3 may start in China as soon as next month. The updated model is said to have a sleeker interior and interior design, and its overall cost will be lower than the current model when production is running at full capacity. Display cars could be shipped to Tesla showrooms later this month. Shares of Tesla right now down just a fraction. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 10:21 on Wall Street. We check the markets for you all day long here at Bloomberg. I'm Denise Pellegrini. We have just a lot going on right now. First up, conference boards, leading index for July, falling 0.4%. That is the 16th decline in a row. And guys, you know what the biggest positive contributor to the leading index was? Stock prices. So how's that for positive sentiment, creating positive sentiment there? The biggest negative contributor, ISM new orders. U.S. weekly jobless claims coming in at 239,000 last week. The estimate was 240, so that's pretty close. Also watching the situation in China, sources telling us Chinese authorities have told state-owned banks to step up intervention in the currency market this week. They do not like it when there is volatility there. Messes up everything in terms of their economic equation. And we're also hearing they're eyeing more tools to back up China's yuan. The Dow right now doesn't need too much backing up itself. It's up 0.3%, 107 points higher. The S&P 500 up 0.1%, 6 points higher. The NASDAQ, though, it's lower, down 0.3%. We're keeping a very close eye on what's happening with the 10-year, because right now the 10-year yield, it has hit 4.3%, high of the day. We're watching to see how much air that sucks out of the room when it comes to stocks. Right now, spot gold is up 0.2%, $18.95 an ounce, and crude oil right now up 1.7%. 80.63 now, we'll call it a barrel. Shares of Walmart, they have turned lower now. Walmart boosting its annual profit forecast, but as we've been talking about all morning, the CFO says still sees uncertainty in the economy during the rest of the year. We'll get Ross Stores. They report after the closing bell today. We're tracking it all for you here on Bloomberg Radio, and that, guys, is a Bloomberg Business Flash.
All right, Denise Pellegrini, thank you so much. She joins us live here in our Bloomberg Interactive Broker Studio. I have to admit, Regina, of all the central banks, I'm probably least comfortable or knowledgeable about what they are doing. So just give us a sense of what the BOJ has been up to really over the last several years and kind of what you expect them to do going forward.
Sure. Thanks, Paul. Thanks for having me, and nice to see you both this morning. So the Bank of Japan has been somewhat of a laggard in terms of central bank policy tightening over recent couple of years. And so markets are quite focused on the timing of their transition to tighten policy, particularly with respect to transitioning out of what they have had in place now for many years, yield curve targeting, which is them targeting the 10-year yield. And so they have recently shifted toward more flexible arrangement or regime with respect to yield curve targeting, which markets are obviously taking as a signal that they are on the move, if you like, and soon to be thinking about higher interest rates at some point. Markets intensely focused on the timing of that and taking every signal they can from the economy to try to gauge when they're likely to move.
And very different, like you were saying, if you juxtapose that against the Federal Reserve and other global central banks that clearly have been on this aggressive tightening cycle for over a year now. How do you think that impacts the global economy? Because Japan is the third largest economy behind the United States and China.
Absolutely, and as you rightly infer, there's a huge yield differential now between the US and Japan, and so one of the things that we've become aware of is that officials in Japan are, waiting for the Fed to be done, if you like, with respect to their tightening cycle, so that they can start to think about how they will move on their own rates and narrow that differential. They have a currency right now which is at levels that they're not entirely comfortable with.
Right, so the yen breaching 145.
Right. So this is a policy driver for them in the sense that they have now, I think, admitted that it's a big factor in how they're thinking about how to transition smoothly out of this ultra easy policy that they've had now for a very long time, and I think that really that rate differential is not going to narrow until they actually move on rates.
Right. So the yen breaching, it's now around 146 against the dollar. How much does that stoke expectations that it could prompt the Bank of Japan to have more intervention from here?
Right. So that right now there is a lot of speculation that they could come in. In fact, overnight I was even reading about expectations that they could come while Japan is asleep, essentially, and do some stealth intervention. There is a lot of focus on when and how they'll intervene and at what level. I think from a broader perspective that whatever that intervention, whenever that intervention is and at what level, it's not necessarily as important as what they do on the monetary policy side. And so the impact on the market, I think, of any intervention, Ministry of Finance officials, execute is not, it has a more transient effect, I think, on markets than does the speculation about what they'll do with interest rates and when.
We've had a change in leadership of the Bank of Japan. Just talk to us about that, what that means and going forward.
Yeah, I think this is a really interesting element. I mean, we're always at pains to try and discern these differences in personality when there's a change in leadership at a central bank. In particular, I think that the exit of the former Central Bank of Japan Governor Kuroda, ushered in this succession of a new governor who comes from a school of thought or an academic background where he relies more heavily on forward guidance. Mm-hmm. That's more the Bernanke, Draghi school of thought. And so I think that one of the elements that's really obvious to me through this transition of the leadership is the extent to which he has been starting to impart that forward guidance. I think that he's going to rely quite heavily on signalling. Rhetorically, the bank has held quite firm to this ultra easy policy, but you can detect little nuances in the way he's shifting the language so that markets are understanding that the bank is on the move.
And also we'll have another update when it comes to consumer prices. And if you looked at the latest data from the prior month, it did advance at a faster clip. How do you view the direction of where those prices could be headed from here? Right, so this is another really interesting element because the headline rate is expected to show that prices fell in this report. That would be consistent with the BOJ's own forecasts. They expect in fiscal year that inflation will have risen, but in the next fiscal year they anticipate that inflation will slow to under the 2% objective.
So they have the same what is this 2% number? Everybody's got a 2% inflation.
The magic 2% number.
I'd never heard
started
of
from
that
New Zealand in the 1980s. And then Bernanke, I think, was
all right,
the
so
one that
Japan's on the 2% inflation watch as well.
They're on the watch, yes.
All right, so I'm looking at the eco function on the Bloomberg terminal and putting it in there for Japan. I guess the forecast is for CPI, I guess the headline year-over-year 3.3%.
Right.
So getting there but not there.
Getting there but not there. And
First time, by the way, I've ever pulled up Japan screen on my eco thing. Okay.
And also on an underlying basis, I think that's the important number. You know, with X Energy, they're very focused on what the core rate is doing.
Okay.
I have to get your thoughts on when it comes to this discussion. JP Morgan actually had a recent note about China's Japanification risks. So seeing similar concerns that Japan did in the early 1990s kind of set the scene for us about how that worked and what that could mean potentially for China.
Well, obviously there is so much concern about China at the moment. It's seeping into market psychology, I think, with respect to how it potentially impacts US Federal Reserve's future outlook and other economies. It's impacting the extent to which we think that central banks might be done in their own respective tightening campaigns. But in terms of the in terms of China becoming Japan, I think we're some way off assessing that is decidedly the outlook for China. Having said that, there are real concerns there, and I think that China experts more adept than I have voiced them for many years.
When I started in the business back in the mid-'80s, Japan was the bomb.
Yeah.
If you were a U.S. investment banker, you had to get a tour of duty in Tokyo. But that's not the case ever for a long time. Give us just the overview. How do you think, or how do economists think the Japan economy will be over the next 5 or 10 years or something?
Yeah, it's an interesting point. I like you, Paul, was in Japan around that time, and it was a global superpower, no doubt. And since it's been in the doldrums, obviously. I think that as they emerge from what has been 25-year slump, the economy is probably not likely to see those heady days again to the extent that they did in the 80s and early 90s. That said, I think, the Japanese officials have very long memories, and they'll be very, very cautious and careful about moving too quickly to curb any kind of ebullience in the economy for fear that they might be reverting back to inflation that's under 2%.
I mean, again, as a U.S. investment banker, there was Asia, then there was non-Japan Asia. So basically, it was Japan and everything else.
Right.
Now it's China and everything else. So it's just how times have changed. Regina Schlager, thanks so much for joining us, giving us a view of that part of the world. Regina Schlager, she is the director of Central Bank Policy Research, SGH Macro Advisors. The yen right here, 146.15 against the U.S. dollar. With our news in New York City, here's Michael Barr.
Paul, Jess, thank you very much. The official death toll in the Maui wildfire rose to at least 111. Recovery teams are making progress searching through homes with their cadaver dogs. Hawaii Governor Josh Green.
A significant force on the ground, so they are now up to 30 dogs. They'll move to 40. There's now going to be another about 225 relief individuals coming.
FEMA says it's sending resources, including more cadaver dog teams. Fulton County, Georgia District Attorney Fonnie Willis has proposed a trial date of March 4th and to hold arraignments for former President Donald Trump and 18 of his associates the week of September 5th. But a number of Republicans are supporting the former president. Georgia Republican Representative Buddy Carter tells us he thinks this latest indictment is politically motivated.
This latest indictment, I mean, this is ridiculous. Here we've got a former president indicted for the fourth time by a justice system that's weighed against him. This indictment in Georgia is not about justice. It's about revenge. And there are 159 counties in the state of Georgia. If I had not known where this one was coming from, I would have guessed. I would have said, hey, I bet it's Fulton County. And it is Fulton County because Fulton County has long been a bastion for Democratic shenanigans in the state of Georgia.
Georgia Representative Buddy Carter was a guest on Bloomberg's Balanced Power. Camp David is the setting this week as President Joe Biden will host the leaders of Japan and South Korea. The Asian allies have been trying to overcome a tense relationship that dates back to World War II. The legal battle over a widely used abortion pill appears to be headed to the Supreme Court. A federal appeals court in New Orleans said that it would limit access to mifepristone. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 10:40 on Wall Street. We check the markets for you all day long here at Bloomberg. I'm Denise Pellegrini. Stocks are mixed. And remember I said earlier the million-dollar question is whether these rising bond yields kind of suck the air out of the room for stocks. Well, that's what everybody's wondering. Scott Cronert, U.S. equity strategist, managing director at Citi, says these rising bond yields do mean stock gains could lose momentum, especially if the bloom falls off the AI rose.
As you begin to move higher through the 4.25, and maybe we're looking a little bit higher, you do begin to reintroduce this issue that as you move away from the AI narrative and re-engage in other stories, rates becomes that, and it does become, in our view, a reason for a pullback phase after the run that we've had in the first 7 months of the year.
And maybe that is why we're seeing a little bit of a pullback today, because the S&P 500 has now also turned negative. And Cronert with us there on the Bloomberg Surveillance podcast. The Dow right now still holding on to some small gains. It's up about 0.2% right now, up 55 points. The S&P 500, it is down fractionally, down 1 point right now. And the NASDAQ, it is down it is down 0.5%. That is about 69 points right now. The yield on the 10-year creeping ever higher, up 4.3038% now. Been creeping higher pretty much all morning. We're watching that very closely for you. Spot gold right now, it's up about 0.1% at $18.94 an ounce. In crude oil, close to session highs here. We've got NYMEX crude right now up 1.76%. That is $80.80 a barrel. And it's a tale of two retailers right now. One is boosting its forecast but trading lower. The other out with a weaker than expected forecast. Those shares are gaining. Walmart shares, they're lower after Walmart boosted its annual profit forecast but said that it sees uncertainty in the economy for the rest of the year. And Tapestry, it's out with adjusted earnings per share and net sales that are lower than forecast. Tapestry Designs and Markets clothes and accessories. Those shares, though, they are gaining right now. And that is a Bloomberg Business Flash. Jess and Paul, back over to you.
All right, Denise, thanks so much. We appreciate that. Denise Pellegrini there with our Bloomberg Business Flash. Jess Met and Paul Sweeney here in the Bloomberg Interactive Broker Studio. We are streaming live on that YouTube thing, so just head over there and search Bloomberg Radio. Jess, you know how much I love the insurance business.
Oh, I know.
What I like even more is that there's people that insure the insurance companies.
Yes.
And those are called reinsurers. Okay, so we've got one of the leading reinsurance companies here in our Bloomberg Interactive Broker Studio, Juan Andrade, CEO of Everest. They're based, where else? Bermuda, scam. But that's how these guys do it. Juan, he's here in our Bloomberg Interactive Broker Studio. Juan, thanks for coming in. Appreciate it.
Thanks, Paul.
Talk to us about the reinsurance business. What's driving your business these days? I'm looking at your stock. It's a $15 billion market cap company. You've got Juan, EG is a ticker, up about 7% year to date, 30% over the last 12 months. What are the key drivers of your business?
Yeah, no, it's a fascinating question. I mean, if you think about the confluence of events that we've all lived through over the last few years, whether it's the pandemic, the supply chain issues, inflation, climate change, all of that is driving demand. And again, as you said, we basically insure insurance companies. So when you think about what's driving our business right now, it's the fact that these insurance companies are looking for protection for earnings volatility, essentially. And so that increases the demand for our product.
And there's been a price correction in the insurance industry. Why?
There's been a significant price correction. You're absolutely right. And it's really down to a supply and demand imbalance. The bottom line is, with all the storms and all the activity that we've seen since 2017, reinsurance companies have deployed less capital into the market, so that's constrained supply. The other thing that's happened on the supply side is a lot of third-party allocators, pension funds, sovereign wealth funds that used to put money into our sector have also pulled out. And so that's created a supply crunch, if you will, in the industry. But at the same time, because of inflation, climate change, all of these other things, there's more demand. So there's basically a gap of roughly $100 billion between supply and demand. And that's what's created the price correction that really started at the beginning of this year in a pretty significant way.
Hey, Juan, when you bump into a climate change denier, what do you say to that person? I always say, like somebody, when I bump into them, I say, go talk to an insurance company. they'll tell you if it's real or not. What do you say?
Well, I think that's good advice, by the way, because that is what we do on a day-in and day-out basis. Just look at what happened in Maui.
Okay.
And I think that's a perfect example of that, right? You know, the island had significantly high temperatures because of what's been happening around the world. Drought, which basically dried all the grasses. And then you have a hurricane that's churning off the coast, putting out 60, 70 mile an hour winds. So once you get the spark that started this and you got those winds, you get, unfortunately, the tragedy that unfolded in Maui. And look, all of this is scientifically proven, right? Wildfires, floods, droughts, all of that is directly related to what we're seeing. You know, one of the interesting statistics that's out there right now, the ocean, whether it's the Pacific or the Atlantic Ocean right now, is at the warmest temperature it's been since recorded history. That tells you something. Now, the end game of that is that you're going to get more severe storms because they fuel off of the higher temperatures in the ocean. So what I would just say is look at the facts.
So are the insurance companies that you insure, how's that reflected in their business? I've heard like a lot of insurance companies won't even do business in Florida anymore. So how do you see that in your business? And I mean, are you charging more for that? Increased risk? How does that affect your business?
It affects us in a number of different ways. So yes, one is we're charging more. That's part of that price correction that we talked about. The second thing is we try to embed the latest science into our models to be able to do better predictions on where storms are going to develop, where they're going to hit, the coastlines, et cetera, et cetera. But the other thing that you're seeing right now, and you've seen the headlines from companies moving out of Florida or moving out of California, there's also public policy issues that we have to address. I think the governor of Florida and the legislature did a nice job with tort reform in Florida because one of their significant issues was not only climate change and the storms that come out of that, but it's also fraud and abuse in the system. And so the governor took strong actions on that. California is a different story. At this point in time, you know, you have a lot of companies leaving the state because the market is not functioning as well as it should be. And at the end of the day, we all have shareholders or stakeholders, and we're for-profit business.
The Hawaii wildfires, insured losses are estimated to be around $3 billion, but at the same time, Hawaii is one of the nation's lowest rates when it comes to homeowner coverage, just because it really hasn't had a ton of natural disasters. How does that affect insurers?
Yeah, it's a great point, because that also goes back to Paul's question on climate change. Hawaii itself is not known as sort of a natural catastrophe hotspot, you know, similar to when you think about Florida or when you think about California. What will happen as a result of this is prices will go up again, right? A lot of claims will be paid. I think, as you said, it's about $3 to $3.2 billion in industry loss that is expected to come out of that how So insurance companies will basically adjust their pricing because the risk is there, essentially.
You guys are a global company. Talk to us about how business is different U.S. versus outside of the U.S.
Yeah, no, look, I've spent a vast majority of my career actually working outside of the United States. And we are global, so we are the fourth largest property casualty reinsurer in the world. We have customers in 115 countries. And, you know, our business is really a relationship business, and you really have to adapt to how you do business in different cultures, right? Whether it's an Asian culture, a Latin American culture, where, you know, before you do a deal, they have to understand who you are, they need to trust you, et cetera. Whether it's in Europe and the US, you might be more direct, get to the bottom line a little bit quicker, et cetera. But the issues are fundamentally the same. At the end of the day, we're insuring risk, so we have to understand what we're taking on our balance sheet, what we price for it, and you also need to understand the geography, the climate, the geopolitical issues, regulatory environments, all that sort of thing.
We have about a minute left. What's your thought on what the reinsurance industry is telling us on where the economy is headed?
Yeah, look, I think if you look at our industry, we're sort of a bright light in what's happening in capital markets right now. And I'll give you our own example. So we just posted in the second quarter a 25% annualized total shareholder return and a 22% plus ROE. And so that tells you sort of what we're seeing in the opportunities that are out there because of the uncertainty in the world right now, heightened risk environment, geopolitical issues, climate change issues, et cetera. So we're pretty bullish about where the industry's going, not only this year, but well into 2024 as well.
All right, Juan, thanks so much for joining us. Really appreciate you taking the time to come into our Bloomberg Interactive Broker studio. Juan Andrade, he's the CEO of Everest, the ticker's EG, Everest Group, a New York Stock Exchange traded company. You guys have an investor day coming up in November at the NYSE, so that'll be big for you guys. Maybe we'll get you back in the studio since you're going to be back in New York. That'll be good stuff. S&P 500, we are pretty much unched on the day. Nothing really happened. Dow Jones up 0.2%. The NASDAQ off 0.4%. WTI crude oil, it's up 2% here, $81 for a barrel of WTI crude oil. We're going to have more coming up. This is Bloomberg. Get some company news right now with Lisa Mateo.
Good morning. Just days after announcing its $8.5 billion acquisition of rival Campari Holdings, Tapestry is reporting profit and revenue forecast for its current fiscal year that came in below estimates. But Bloomberg's Simone Foxman says there is one bright spot.
It does see high single-digit growth from Asia and China. That is a large part of its international sales and a place where there is potential to sell Michael Kors. That is one of those Capri brands.
Now, Tapestry is a parent of Coach and Kate Spade. Shares of Tapestry right now, well, they are down a fraction. Wireless carriers are losing billions as demand for smartphones slows. Bloomberg's Jeff Bellinger reports.
AT&T, T-Mobile, and Verizon collectively lost nearly $5 billion in equipment sales over the last 12 months compared to the previous year. Executives say a lack of new devices from smartphone makers is part of the problem, and they note customers are waiting longer between upgrades. T-Mobile's equipment revenue fell 23% last quarter, while AT&T's slipped 7%, and Verizon's postpaid phone upgrades dropped 34%.
Now we'll check in with a few of those now. AT&T, well, it's down just 0.2%. Verizon down about 0.5%. T-Mobile down about 0.4%. And speaking of T-Mobile, the company is being sued by a New York couple over an unauthorized SIM card swap. Now the plaintiffs say a hacker was able to gain access to their private phone data and steal assets worth more than $130,000. Now the SIM card was swapped by employees at a T-Mobile store in California. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Jess Met and Paul Sweeney here in the Bloomberg Interactive Brokers studio, looking at the markets today. Not a lot of movement in the indexes per se. This S&P 500's up 0.1% of 1%. NASDAQ off 0.2% of 1%. We're keeping an eye on the yield space higher. 10-year Treasury up 4 basis points, 4.29%. Also call out the 2-year, we're at 4.95%. So on that 5% watch for the 2-year. WTI crude oil up 2% today. Solid $81 per barrel. Bitcoin down almost 2%, $28,400. So broke through that 29,000 level it had been holding for a while. Right now, let's go to world and national news with Michael Barr in New York.
Paul, Jess, thank you very much. 10:56 now on Wall Street. The search is ongoing in Maui, where at least 111 people are known dead. President Biden spoke in a pre-taped message that aired today on ABC's Good Morning America.
On Monday, Jill and I will travel to Hawaii to convey in person our grief and solidarity and commitment to the people of Maui.
Bloomberg's Nancy Lyons has more on the government's latest update on the Hawaiian disaster.
FEMA Administrator Deanne Criswell says the images the world is seeing of the fire devastation in Maui cannot fully convey what the people of the island are going through.
It's the level of devastation from this fire and the feeling of loss from such a culturally rich community that was really palpable everywhere that I went.
Criswell is back in Washington after overseeing operations in Maui. She says about 700 federal personnel are still on the ground there, helping search and rescue teams look for victims. In Washington, I'm Nancy Lyons, Bloomberg Radio.
Fulton County District Attorney Fani Willis is asking a judge to begin the Georgia trial of former President Trump and 18 of his associates on March 4th. That is a day before the Super Tuesday primaries. Those indicted earlier this week have been charged with allegedly conspiring to overturn Georgia's 2020 election results. The fate of the abortion drug mifepristone is now in the hands of the Supreme Court after a federal appeals court ruled the drug should be more tightly regulated than it is now. The case revolves around the FDA decision to approve the drug more than 2 decades ago. For now, it won't change women's access to the drug. Transgender youth in North Carolina have lost access to gender-affirming treatments after the state's Republican-controlled legislature voted to override Democratic Governor Roy Cooper's veto of the measure. North Carolina now becomes the 22nd state to enact legislation restricting or banning gender-affirming medical care for minors. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Michael Barr. This is Bloomberg. Jess Bull.
All right, Michael Barr, thank you so much. We appreciate it. Boy, a headline really caught my attention. Buffett's favorite valuation gauge flashes caution. Jess, what do you know about that?
So I did write a taking stock column about this. So this is where Warren Buffett had talked about this a couple of decades ago. He likes to look at the Wilshire 5000 and dividing it by where U.S. GDP is annually. If you take a look at the chart, it's actually close to its highest level in about a year, and it's risen close to about 20% since the S&P 500 actually hit its low last October. Now, it's not necessarily, flashing a smoke signal at this point, but when I'm speaking with some of my sources, it's obviously just one indicator of many when you think about valuations. So maybe giving some credence to when we are in obviously a seasonally weak period of the year, how we could see that pullback. But of course, your buddies over at Bloomberg Intelligence, I was also crunching the numbers from a valuation perspective from them. So if you're looking at the S&P 500, excluding the top 5 market cap companies, so Apple, Microsoft, Amazon, Nvidia, Alphabet, the S&P 500 trading about 18 times forward earnings. If you include all of that, obviously it's going to be a little bit higher, closer to 20, but just those 5 names trading around 30 times forward earnings. Amazing, it is when you see that chart. So when I'm talking to some of my sources, they're like, hey, 18, maybe not necessarily cheap, but that's not 30.
Exactly. I mean, that's a great point. We just got through the earnings cycle here, and we've talked a lot about how those Magnificent 5 or Magnificent 7 stocks really powered the market, and you got to adjust for that, both in the performance of the markets as well as the valuation.
Nvidia reporting on the 23rd next week.
Oh, good. That'll talk about
last of the Magnificent 7.
We'll have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, our C-suite conversation of the day, Hassam Naji, CEO of Marcus & Millichap. We're going to talk about commercial real estate. Where do we go from here, particularly in some of the bigger markets? Plus, we need to break down those Walmart numbers from this morning. Jen Bartashis, Senior Industry Analyst at Bloomberg Intelligence, will join us to do just that. It's Thursday. That means we check in with Barry Ritholtz, founder of Ritholtz Wealth Management and host of Masters in Business. I want to see what he's thinking about these markets, what he's thinking about the world.
Can't wait.
And maybe what he's driving these days. Yes. Just because Matt's not here doesn't mean we can't talk about cars. But first, let's kick this hour off with a Bloomberg Business Flash. Denise Pellegrini.
Hey there, Paul. And the big thing, of course, is what's driving the markets. It's 11:01 on Wall Street. We do check the markets for you all day long here at Bloomberg. Stocks, they're mixed right now. The yield on the 10-year, it is higher on the day. And that makes investing in bonds more attractive than stocks right now, since everything is relative. Makes it a dynamic where some are questioning whether it is less interesting to invest in stocks. And that's according to Troy Gajewski. He is Chief Market Strategist at FS Investments.
Now cash and increasingly T-bills and Treasury notes and bonds are becoming competition for other assets. So certainly, one of the major drivers of all the asset inflation we've seen in the last 40 years has been lower and lower rates, right? Which justified paying a higher and higher price for every asset on the planet. As that moves in reverse, naturally, you should have multiple compression. You should demand higher yields in all strategies. You should demand higher total return, even in things like private equity or private equity secondaries, in order to keep that spread to risk-free as attractive as it's been over the last 15 years.
And Gajewski with us there on the Bloomberg Surveillance podcast. Right now, the Dow, it is up for 0.1%, up 50 points. The S&P 500 pretty much flat, up fractionally. The NASDAQ, it is lower now on the day, down 0.4%, down 54 points. Bloomberg headline out, beating estimates no longer spurs stock rally as Fed fears rain. We're seeing that with some retailers. Walmart shares, they are lower. Walmart boosting its forecast again, but also Walmart CFO says it sees uncertainty in the economy for the rest of the year. And also Tapestry shares, they are higher. That's after they kind of guided lower for their year. Some drama overseas. Sources telling us Chinese authorities are encouraging banks to intervene in behalf of the country's currency. And in Amsterdam, stock called Adyen, the company shares are down 40%. This is a Dutch payments company. Why do I mention it here with U.S. markets? It says business grew at a lower rate than anticipated in the digital sector. Thank you primarily to what's going on in North America. And that is a Bloomberg Business Flash. Paul and Jess, back over to you.
All right, Denise Pellegrini, thank you so much. We appreciate that. Jess Met and Paul Sweeney here in the Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so head over there, youtube.com, and search Bloomberg Radio, and that'll get you where you need to go. Looking at these markets here, as Denise was just reporting, not a whole lot going on.
Energy, though. Look at energy within the S&P 500, up more than 2%. Obviously, that correlation with high oil prices, but we were looking at our equities team about the extreme outflows in energy stocks. The ETF's tracking, there's about 80 of them that are U.S. listed, and more than $11 billion in outflows. So some people wondering at what point was it at a contrarian zone. So we'll keep an eye on that when you're looking at these stocks higher.
Yeah, absolutely. Let's check in with Alexandra Semenova. She covers the markets for Bloomberg. She joins us live here in our Bloomberg Interactive Broker Studio. Alex, what are you looking at today?
Hey guys, good to be on with you again.
Back
we
again.
We got to talk about NVIDIA because obviously the company is reporting results next week on August 23rd. But as we have seen some skittishness in tech stocks, it seems like people aren't so worried about NVIDIA. Some of the concerns among investors have been that this stock has already rallied more than 200% this year. How much more room does it have to run? But that's not a concern among Wall Street analysts. It got a wave of upgrades on its price target ahead of its earnings next week. Rosenblatt Securities raised its price target from 600 to 800 on Wednesday, saying that it sees room for an even more dramatic rally. It also got price upgrades from Oppenheimer and from Piper Sandler. And then Barclays said that it was surprised that NVIDIA hasn't moved much over this month. There's clearly some hesitation to buy up a name that is up more than 200% this year, but it says that we actually believe this stock will look cheap coming out of its earnings. So investors are ready to pounce.
I know. It's only down 8% from that high.
I was curious your thoughts, Paul, with your experience on the sell side. At what point does it hit an inflection point as far as being a contrarian indicator when you see a particular wave of upgrades? Like, how much more of that would you need to see?
Well, it's easy to say that the analysts were late to the game.
Exactly.
But I would say in this particular case, that was a material change to the company's outlook and to the outlook for AI and for the outlook for tech. That's how profound that was.
Right, up almost 200% year to date. NVDA is the ticker. It's a wild move there.
Yes, but what I will say, and who was it? Mandeep Singh from Bloomberg Intelligence raised this point several weeks ago, which is, boy, this company better really deliver when they report their numbers, because man, 200% increases. It's really, it's almost like, gee, I might like to, buy some puts here ahead of this thing. But if I were a trading type, but we'll have to see how that plays out. What else you got?
So I want to talk about the shift in sentiment that we've seen in recent weeks. Of course, everyone has been really excited about the prospect of a soft landing that's been driving the rally the prior couple of months. But now we're seeing a change where investors are kind of worried that economic resilience will pose an upside risk to inflation. That is driving the narrative. We're back to higher for longer rates. And you guys know I cover strategy. The strategists have been a little quiet as we're seeing this kind of turn.
We didn't get a note from Mike Wilson over at Morgan Stanley this week?
No note from Mike Wilson this week. I was waiting for it Monday morning, didn't drop, but we did get one from Marko Kolanovic over at JP Morgan Chase, and he actually described exactly what we're seeing this week. He said that inflation is likely to remain sticky around 3%. He sees that as a concern, and he sees the narrative changing from soft landing to more extended tightening cycle, which is what we're seeing at least for now. Obviously, we'll get a lot more clarity after Jackson Hole, and we'll see whether or not the rally has staying power into the second half of the year. So far, some of the sources that I spoke to said that they had predicted this volatility in the summer months that we've seen. But, based on the first half of the year, if you look historically, whenever we've seen these types of returns, usually the rally has continued into the second half.
So what are you hearing from BlackRock?
Yeah, BlackRock is also an interesting one. They're a little bit contrarian because obviously we have seen a recovery in earnings. The consensus is that margins have troughed at the end of 2022, but BlackRock actually says that they're concerned about another margin squeeze ahead. They say that labor shortages will continue to weigh on companies, that inflation is still an issue, and we're not out of the woods just yet on margins.
All right, Alex, thanks so much for joining us. Alex Semenova giving us the breakdown on
reporter on our
markets. Star reporter, absolutely. I'll go there.
You guys are too good to me.
Absolutely. All right, let's talk about commercial real estate. This is near and dear to my heart because I walk through Midtown Manhattan every day back and forth to Penn Station, and I'm firsthand, I can check out what's happening. Our next guest knows about what's happening too. Hessam Naji, he's the CEO of Marcus & Millichap, which is a New York Stock Exchange traded company. MMI is the ticker. He joins us live here in our Bloomberg Interactive Broker studio. Hessam, thank you very much for joining us. All right, I walk back and forth twice a day, Midtown Manhattan. I look up and there's a lot of empty space here. This is a disaster in certain big cities. We'll get to some of the good parts of commercial real estate, but what happens to the New Yorks, the San Franciscos? In reality, they're not converting all this stuff to condos. What do you think? How is this going to shake out?
Good morning. Thanks for having me on. Great to see you again. It is going to be painful in the next 2 to 4 years. There's no way around it. But the bifurcation of what's happening with newer, high-amenity office space versus older, obsolete office space is the story. In that overall demand has shrunk. The pandemic has changed societal patterns that are not going to come back anytime soon. We're seeing improvement, by the way. We're up to about 48, 50% daily attendance, not vacancy rates, but utilization rates of people in office spaces, which is amazing to even share with you, and that we're at 48 or 50%, up from 10 or 20% right after the pandemic. It is a profound reduction of office space demand, which means quality buildings can be more